Good morning and welcome to the Agriculture Advisory Committee meeting. As the AAC designated federal officer and acting chair of this committee, it is my pleasure to call this meeting to order. Before we get started, there are a few logistical items that I've been asked to mention to the committee members and invited speakers. We have a webinar audience with us today, so please make sure to identify yourself before you begin speaking. Please ensure that your microphone is on and that you are speaking clearly into the mic so that the folks in the room, as well as the webinar audience, can hear you. If you would like to be recognized during these discussions, please change the position of your placard so that it sits vertically on the table, like this, or raise your hand to be recognized. For AAC members participating by webinar, of which there are several, your lines will be muted during the commissioner's remarks, but otherwise will be open. We'll make sure to call out to you for comments periodically. Please make sure to identify yourself as well before commenting. Finally, please refrain from using electronic devices during this meeting. We have a full agenda before us today and would like to ensure full participation by all committee members. And also note for those calling in, please keep your phones on mute until you are ready to speak. To begin the meeting, I would like to turn to Chairman Giancarlo, the AAC sponsor, for his opening statement, followed by Commissioners Quintens, Benham, Stump, and Berkovitz.
Thanks, Charlie, and thank you all. Thank you all for being here this morning. Good morning. It's good to see everybody. I know somebody's taking some photographs there, so get those photographs because this is amazing. You've got all 5 commissioners of the Commodity Futures Trading Commission here in Kansas City today to meet with all of you. If this commission is not committed to agriculture, I don't know what is, and I don't know how much more we can do. This is really a strong commitment by us to the industry that all of you serve to make sure that we're doing our job, everything we can do to make sure our markets serve your needs and the needs of your clients and your customers. So we're really delighted to be here, and it's something that will continue. I want to thank Commissioner Benham for overseeing this meeting last year here in Kansas City. He's here today by way of Tokyo. He just flew in and arrived last night. So another statement of our commitment to this, that he made sure to be here and to be here on time for this meeting this morning. Last year, he oversaw a committee discussion with a very good discussion about ensuring that price discovery and risk management endure as agricultural markets evolve increasingly rapidly. That meeting was the first CFTC Advisory Committee meeting in anyone's memory that took place outside of Washington, and today's meeting is very likely the second. But before we get down to business, I'd like to pay homage to one of our CFTC predecessors, Kalo Heineman, former CFTC chair, native Kansan, and livestock producer. It was Chairman Heineman, in fact, who was responsible for the creation of the Ag Advisory Committee. He reasoned that the Commission would invariably make better policy and regulatory decisions if it increased its direct engagement with agricultural market participants and their representatives. Chairman Heineman was also a firm believer in bringing people with disparate viewpoints together to discuss important market issues to reach consensus. And it was in that spirit that we've seated here together one of the most diverse and experienced memberships of any Ag Advisory Committee. Chairman Heineman was not only a proponent of marketplace engagement, he was also a champion of marketplace innovation. One of his signature achievements was the reemergence of options in agricultural markets. Now, the original Commodities Exchange Act of 1936 banned options outright, and for the next several decades, they were not traded on U.S. exchanges. But finally, in 1982, redesigned options were introduced to agricultural markets. And during his tenure, Chairman Heineman crisscrossed the country speaking to agricultural groups, explaining how this innovation could provide an affordable means of hedging extreme price risk for farmers. And he was absolutely correct in that options in agricultural markets serve that function today. And it's useful to reflect on the legacy of Chairman Heineman as we begin our work in earnest on today's Ag Advisory Committee. You know, it's easy to say no to an idea that may be novel or controversial. But what's hard to do is carefully explore that new idea and try to develop it into something that can enhance markets and benefit market participants. And it's equally hard to create a regulatory environment that supports that type of continued innovation. But let us not take the easy road, but the hard one, in order to ensure that the deepest and most liquid agricultural markets in the world remain a place where farmers and ranchers, grain elevator operators, producers, and processors meet to manage risk and discover prices into the future. Today, we'll have panels on the future of FCMs and cash market innovations, both very important and timely topics. And the CME group will also talk about the evolution of electronic trading in ag markets, another very timely topic. And we'll close by going over new business, including some subcommittee recommendations. As Chairman Heinemann foresaw, advisory committees are an important part of our work at the CFTC, and clearly my colleagues and I take them very seriously. These committees facilitate communication between the Commission and market participants and provide a forum for information sharing and policy recommendations on a variety of regulatory and market issues that affect the integrity and competitiveness of U.S. markets. They enable communication between us and the ag community and various agriculture-related organizations that are critical to effective market oversight and policy development. And accordingly, next week in Washington, the CFTC's Global Markets Advisory Committee, sponsored by Commissioner Stump, and the Energy and Environmental Markets Advisory Committee, sponsored by Commissioner Berkovitz, will hold public meetings. And we also recently had a great discussion at the Technology Advisory Committee meeting sponsored by Commissioner Quintens. Each of these meetings is important to the work of the Commission, and I salute my fellow commissioners for their sponsorship and support, and all of the Advisory Committee members and participants for their commitment to them as well. We continue to invite interested members of the public to engage with us through this Advisory Committee structure. Thank you again for being here, and I look forward to today's discussions.
Thank you, Chairman Giancarlo. Commissioner Quintens.
Thanks, Charlie. And thank you, Mr. Chairman, for your leadership, not only in organizing this advisory committee, but in organizing and being the impetus and the driving force behind our second annual agricultural conference. This is going to be a great legacy of your chairmanship, and I think it's something that's crucial, as you mentioned, from the perspective of the prior chairman. The more that we at the CFTC, the commissioners, the senior staff, and the rule writers engage with growers, producers, end users, the people, entities, and businesses that use our futures and derivatives markets to actually hedge, transfer their risk to those more able and willing to bear it. The more rational we make our rules, the better we make our processes, and the more we are held accountable to those that depend on these markets for their livelihood and support of the economy. I made a commitment when I first joined the Commission that I would get out of Washington and visit farmers, ranchers, producers, growers in their places of business. I'm very fortunate to say there are a number of people around this table that I've been able to do that with. So thank you for welcoming me to your businesses. I think I've visited 13 states so far. It's not as many as the 23 or 25 that the chairman has visited, but I have 28. Still counting, but I haven't given up yet, Mr. Chairman. This marks actually the third time that I've been to the great state of Kansas, which is the most of any. So very pleased to be back, and thank you all for participating and coming from near and far to be with us and share your views. Thank you.
Thank you, Commissioner Quintens. Commissioner Benham.
Thank you, Charlie. Thanks, Mr. Chairman, for hosting. I would not pass this committee along to just anyone, so it's in good hands with the chairman. It's great to be back in Kansas. Like the chairman mentioned, I got off of a flight last night, and one of the themes of a quick fireside chat I had in Hong Kong, I was in Tokyo as well, was the diversity of our markets, from obviously large financial players, but also to all of you in the ag space that we care about deeply. It's sort of the origin and the roots of our agency and the derivatives market. So it's great to be here. I look forward to this morning's conversation. And thanks again to the chairman. Also, thanks to Charlie and Krista Lackenmeyer. I know they do a lot of work for this committee. So look forward to today. Thank you.
Thank you, Commissioner Benham. Commissioner Stump.
I would thank all the same people who have already been thanked. So a tremendous amount of work goes into putting these meetings together, so enough can't be said about Charlie and Krista's work and everyone. And also I see her hiding in the back there, so thank you all very much. For me, this is really like coming home. I grew up in the ag space, so it's interesting that the CFTC's jurisdiction has expanded so broadly, but I really am grateful to the chairman for ensuring that this legacy component of what we do remains a priority. And so it's also really great to see so many friends, both around the table and in the audience. And in fact, there's a former acting chairman of the CFTC, Mike Dunn, in the audience, who's also trying to hide back there. So. That's all.
Thank you, Commissioner Stump. Commissioner Berkovitz?
Thank you, Charlie. Thank you, Mr. Chairman, and thank you to Krista and Ann and everybody I know who worked hard to make this meeting happen. It's a great honor for me to be here. This is my first Agricultural Advisory Committee meeting. As a commissioner, I've observed these meetings in my prior service at the CFTC, and I worked on Capitol Hill, and I've watched a number of these meetings, and so it's actually a great honor to be participating in this one. As been mentioned, we are the Commodity Futures Trading Commission, and the core commodity in our jurisdiction is really the agricultural commodities. These are enumerated in the Commodity Exchange Act. They're the basis of our markets going back to the origin of our markets going back 150 years. We're overseen by the agricultural committees on both sides of the hill. So this really is our core jurisdiction, and our core mission is to make sure these markets work for you. And that's the purpose of these markets, to ensure that commercial end users, farmers, ranchers, producers, merchants, whatever, can use our markets to hedge and manage the risks they face in their businesses. So we're absolutely committed to making these markets work for the folks in the markets, and I'm glad to be here and looking forward to learning more about the issues in those markets. So thank you very much.
Thank you, Commissioner Berkovitz. I would be remiss if I didn't thank the several people who are behind the scenes, but most important to making this actually run as smoothly as it has so far. So I'd like to thank Josh Griffin, Cindy White, Michael Jones, Andrew Brighton for all their hard work in getting this to go very smoothly today. So thank you. Before we get started our first panel discussion, I would like for members of the committee to introduce themselves. We'll go around the table, beginning with Mr. Joe Barker.
Joe Barker. I am here representing the National Council of Farmer Cooperatives. In my day job, I work for CHS in our FCM capacity. So, thank you.
Chris Betts, here representing Michigan Agribusiness Association. I work for Michigan Agricultural Commodities as the risk manager.
Darrell Blakey, representing National Cattlemen's Beef Association.
Robbie Boone, represent with the Farm Credit Council. We're the National and Trade Association for the Farm Credit System. Glad to be here today.
Good morning, Amanda Breslin, representing the Coalition for Derivatives End Users, and in my day job I work at Chatham Financial.
Good morning, I'm Ed Gallagher. I'm representing the National Milk Producers Federation, and I am employed by Dairy Farmers of America.
Good morning, Justin Tupper here representing U.S. Cattlemen. I'm from St. Ange, South Dakota. I also run a sale barn in western South Dakota there.
And I'm Steve Strong. I am the representative for NAGA, the North American Export Grain Association, and I work for Bunge in St. Louis.
Good morning. I'm John Owen. I'm representing USA Rice Federation. I'm a rice, cotton, corn, soybean producer from Northeast Louisiana.
Good morning. My name is Randy Melvin. I'm representing the National Corn Growers Association, and I'm also a farmer where I farm with my family, my wife, parents, and brother near Buffalo, North Dakota. And we raise corn, soybeans, navy beans, pinto beans, black beans, and wheat.
Good morning. Tom Cadillac, representing Futures Industry Association. My day job, I'm the president of ADM Investor Services.
And good morning, Matt Hines with American Farm Bureau. I am a small cow-calf producer in northeast Kansas, so not too far away from here, and also a licensed commodity broker with an office in Manhattan, Kansas.
Thank you. We also have several folks joining us via phone. If you could introduce yourselves. Thank you.
This is Larry Bergen. I represent National Farmers Union. I'm a corn and soybean farmer from southeast South Dakota.
Rob Kramer, representing the Futures Industry Association Principal Traders Group. I'm also CEO of Geneva Trading, a principal trading firm based in Chicago.
Neil Driscoll, representing Managed Funds Association, and I work at Citadel, the hedge fund out of Chicago.
My name is Hayden Wands. I'm representing the American Bakers Association. In that association, I chair the Commodities and Agricultural Policy Committee, and I work for Grupo Bimbo.
Mark Scanlon with the Independent Community Bankers Association of America in Washington.
Monty Peterson, director with the American Soybean Association and a farmer of soybean and corn farmer in southeast North Dakota.
Good morning. I'm Chris Clinklin. I'm representing the National Association of State Departments of Agriculture, and I'm also the Deputy Director at the Missouri Department of Agriculture.
Do we have anyone else?
Good morning. Thomas Hogan. I'm representing the Cocoa Merchants Association of America, and my day job is president of General Cocoa Company in New York City.
Okay. Thank you all again for your commitment to serve on this committee and for being here today. As I noted in the agenda, our first panel discussion will focus on the current operational and regulatory environment for FCMs. The rule set has been in place for several years, so now is a good time for us to learn from you about new challenges facing FCMs, and specifically how the Commission can support the operational efficiency and long-term availability of FCM services to the agriculture sector. Our panelists are Matthew Culkin, who is the Director of the CFTC's Division of Swap, Dealer, and Intermediary Oversight, Joe Barker, President of CHS Hedging, and Tom Kadlick, President of ADM Investor Services.
Thanks, Charlie. Good morning, everybody. I'm glad Tom and Joe came to sit with me. I was feeling a little isolated over here. So I'm Matt Culkin. I'm the Director of the Division of Swap Dealer and Intermediary Oversight, one of the Commission's 4 operating divisions. I'm based in Washington, but DSIO is about 75 employees. We are in Chicago, Kansas City, New York, and of course, D.C. I want to just explain a little bit about the work we do. So we, as the name implies, we look at swap dealers, but we also look at FCMs, commodity pool operators, commodity trading advisors, introducing brokers, and RFEDs. I want to share with all of you, we recently completed an exercise where we adopted a mission statement for the division, which is designed to support the mission of the Commission. The division's mission is to protect derivative market users and their funds by ensuring the financial integrity, fitness, and fair business conduct of derivatives market intermediaries. And so we look back to this mission statement very frequently when we're talking about our regulations, the policy matters before us, and when we're talking with our registrants about either the rulemakings or compliance matters that keep us very busy. So I'm just going to spend a few minutes talking about some trends and some issues in facing the FCM as an industry broadly, and then happily turn it over to Tom and Joe to talk about their experiences personally. But I'm going to present information designed to sort of spark a conversation for the rest of the time we have together. I speak for the entire division when we're keenly interested in hearing both from FCMs but also from customers about how their experience is going. For those of you I've had the chance to meet with since I joined the Commission, we're acutely aware and sensitive to the market dynamics at play, and in particular how our regulations impact both the FCM's operations, but as well what that means for their customers. So with that, I'll jump right in. And so the first thing I wanted to share, this is sort of what I think everybody probably expected us to present. Oh, I should mention, I think the slides are working on the WebEx, but there's a glitch in the room. So some folks have copies, but these might not be showing up on the screen. Is that?
It is showing on the WebEx.
Okay. So for folks who don't have a copy of the slides, it's a count of registered FCMs over the last 10 years. And the number of FCMs with customer assets has gone from 76 in 2008 down to 57 in 2018. So a decrease of 19 firms, including FCMs without customer assets. There's been a decrease of 71 FCMs over the last 10 years. I think most people were probably aware of those numbers or that dynamic at the least. And what I'm hoping that we'll talk about today is why. And what is the impact of that market evolution meant to the marketplace? What has it meant for end users? So one of the trends we've observed is that some FCMs have transitioned to introducing brokers. Over the last 10 years, from 2008 to 2018, there have been 22 FCMs that have withdrawn their registration, but then registered as introducing brokers. This doesn't take into account any IBs that might have later withdrawn their IB registration status. And what this means from the customer standpoint is that they would still have access to the same services, but the trades would be cleared through a different clearing firm. So just an interesting observation that we wanted to put on the table early this morning. When we look at the assets of the FCMs, while the number of FCMs has gone down over the last 10 years, when you look at seg and secure assets, it's remained relatively flat. And so what the slide shows is that the futures and options assets have remained pretty consistent, around $150 billion. Part 30 funds similarly add another $50 billion or so. But what we've seen an uptick in is seg and secured assets tied to swaps. And from 2008 to 2012, it's a pretty small number. And from 2012 to 2018, we see an increase in that part of the market. And so that raises an element that I'll come to in a second, but just an increased number of hedging tools that are available depending on the sophistication of the customer and allow potentially for another a vehicle. So this is just a plug for the slide before you. This is all financial data that we pulled from publicly available materials. If you go to cftc.gov and search for financial data for FCMs, you can find a lot of this information. Similarly, for the division, we've created our own website. So if you're looking for FCM or IB regulations, rulemakings, no action letters, or other resources, including links to a lot of NFA materials, we've put all of that in one place. So before I turn it over to Tom and Joe, I want to just talk a little bit about some of the market factors that we're aware of. So we look at this in sort of four different buckets. There's costs, there's market evolution, there's customer evolution, and then what we call external forces that are having an impact. So when we look at the cost structure, there are, of course, regulatory compliance burdens, and I think we'll spend some time talking about that this morning. The capital demands on the firms, the technology investments required for firms simply to maintain their infrastructure. There are a number of market dynamics at play. Flat or rising interest rates, cross-border competition, sort of the world flattening, and then the introduction of hedging substitutes, so not just traditional futures contracts. Of course, the customer base has evolved as well. There's been consolidation in the end user community. There's increased price competition, both from customers of FCMs, but also of the end user customer themselves. And there's been increased competition for products and services. We see that both in the FCM and in the IB space. We see that in terms of who can provide access to markets, access to hedging tools, who can provide the best price, who can provide the best service. And then, of course, all of that is tied to any other existing commercial relationships where customers are looking to sort of bring efficiencies to bear when they're looking at their balance sheet. So I hope that's a helpful way to sort of tee up the discussion this morning. But I, of course, am coming from Washington and very much looking forward to hearing Joe and Tom's perspectives from the market itself. Thank you.
Okay. Am I next? Yes. Okay. Joe Barker. I am the Director of Brokerage Services for CHS Hedging, and under our structure, we have a senior management team, and where I carry the title Chairman of our senior management team. CHS is the largest farmer-owned cooperative in the United States, with many different business units, everything from refining oil to importing fertilizer, retailing fertilizer to farmers. And I tell people we buy grain by the truckload, move it by the train load, and sell it by the shipload. So these are kind of our roots for what that might imagine. With that structure and with that being our parent, we are a farmer-owned, non-bank FCM that specializes in agriculture. We are a clearing member of the Minneapolis Grain Exchange and the legacy Chicago Board of Trade contracts at the Chicago Mercantile Exchange. Those are the only two markets we clear today. The structure under which we are, which is a farmer-owned cooperative running an FCM, used to be quite common in our marketplace. Actually, some of the larger FCMs today have their roots in that business model. But this is a somewhat rare business model in today's structure, although we found it to be quite stable for our business. As was talked about, the business relationships that we have with our owners has created some pretty strong relationships with our customer base that we've had for many decades. We don't do any prop trading as an FCM, so we're a little different than a lot of the large bank FCMs that run their own swap desks and will provide markets in swaps. We simply broker swaps for our grain elevator community and also our energy clients to help them manage their price risk. We stand in the middle on the bilateral agreements. We have to report everything, but we don't make our own book, so to speak, in the swap world. So that gives us some advantages in being able to shop markets and find the best market we can and save our clients some time. But it does create just a little bit different business model than what you might be used to from other larger bank-owned FCMs. As you might guess, our customer base is highly focused on agriculture. Well over 80% of what we do is grain. If you add in the livestock and dairy contracts, that's over 95% of the business that we do in the futures and options market. We were asked to talk about the trends in the business over the last 10 years. So to be clear, 10 years ago, at about this time, I would have been walking onto the trading floor at the Kansas City Board of Trade, which no longer exists 10 years later. I managed our operations there. We had a trading desk with about 13 employees that handled customer orders in the open outcry market. And so we have seen a major trend towards electronic trading. I would tell you from my opinion in dealing with our agriculture clients, this has been embraced and has brought some definite efficiencies to the marketplace. So I'm not here to complain about that transition, but it has been a major trend in our marketplace that has impacted things. As the market went more electronic, everything became more efficient. The service levels became harder to differentiate for some customers. Some customers proceeded to shop the marketplace on price. Others continued with their business relationships and focused on the services and other things that are offered by FCMs and IBs for this discussion. We happen to have been an early adopter of electronic trading, which is probably why we survived the recent trend. And with the business relationships we have, we still bring those tools directly to the farmer and directly to the grain elevator at a very low cost, I believe. One of the recent trends we've seen in the last 10 years is the regulatory burden. And I don't mean to over talk about it, but in the last 10 years, our back office staff is up over 30% in people, almost exclusively focused on handling the regulatory burden that an FCM faces. And being one of the smaller FCMs, we still have to abide by the same rules that everyone else does. So every year, we have our annual AML audit, and a money laundering audit. We have our annual risk management program audit, which we've hired a full-time person just to manage our risk management program. We have our annual ISSP audit, our Internet Security Protocol audit. Then we have our annual DSRO audit, which is for us. Our DSRO is the Chicago Mercantile Exchange. That is a highly intensive audit that can last many months and goes through everything that those previous 3 audits went through. And then we have our annual financial audit that is, for us, is done by PricewaterhouseCoopers at the end of our fiscal year, must be filed within 60 days, and goes through everything that the previous 4 audits went through. And so over the last 10 years, this increase in regulation and trying to stay current on those regulations has been a solid trend in our business. So really what we've seen is a trend towards electronic trading, which has made everything more efficient. It's made the customer shop us on price. And we've seen an increase in regulation, which has caused us to increase our costs and headcounts of our audit and regulatory staff. So those are the trends that I was asked to talk about. So hope I didn't overstate that. The one thing I do want to say is we continue to see, especially in our business with our specialization in agriculture, many loyal customers who do really appreciate the service that we can provide. Like many of my peers, we take a lot of pride in our knowledge in these markets, and there will always be customers that are willing to pay for that service and knowledge. We do a lot of education, direct to producers. It's a pretty important part of our budget. We go to many direct to producer conferences where we're able to pick up clients that are willing to have a broker that will have that expertise and be able to bring that to them. So I guess those were my prepared comments that I wanted to make for you this morning. Thank you.
Mr. Barker, can I just ask a question? With regard to those audit requirements, you said that you're one of the smaller players in your space. Are there any portions of that, I don't mean to put you on the spot, but just off the top of your head, that could perhaps be better calibrated to, say, smaller FCMs like yours without undoing the value of that audit process? Are there elements of it that perhaps could be better calibrated to a smaller size FCM that might be appropriate for some of the large Wall Street-based FCMs, but maybe better tailored to a smaller FCM like yours and some of your smaller competitors that might give some relief without undoing the value of those annual reviews?
Sorry. Everyone's going to have an opinion. It is mine that I've been in this role for a couple years. I was a frontline broker for the first 17 years of my career before I stepped into this director level job. It's been quite eye-opening to see that we go through an AML audit, an RMP audit, an ISSP audit, and then we do our DSRO audit that audits everything that the previous auditors already audited. And for a small FCM with about 180 million of seg funds, which is very small for this world, and I'm aware of that, that burden is large. So if there was a way to somehow, that creates a barrier to entry. So if you're worried about the smaller FCMs and why they've left this space, I believe this is a solid trend in what's happened. I believe that our customer seg funds are vital. I mean, it's part of our business. We don't, everyone knows the history of what's happened in our industry the last 10 years. But yes, it would be nice if we didn't have to go through those audits and then get re-audited on the same thing again.
I don't know about undoing the audits, but if you could think about areas where streamlining, where tailoring or calibration to smaller firms as opposed to larger firms, I think that would be an appropriate area for an advisory committee like this to take up and bring some ideas forward. So I put that out as a suggestion.
Thank you.
I will just expand on, Mr. Chairman, your comments. I started my career as an auditor. I love audits, but I don't mind getting very engaged as to the scope of the audit. And as a smaller FCM or a larger FCM, you can adjust that scope. And to Matt's points earlier, the mission statement is well defined, and that came out of the financial crisis. So the coaching I do and the engagement we do with the various audits that we have is tailor it specifically to our business model, tailor it to the regulatory requirements. But our scope is much different, much different, and we have a good, positive relationship with auditors but it's a 360-degree discussion, and we're not afraid to challenge the scope. So I think your comments are spot on.
I would just note, of the audits you mentioned, they all have different constituencies. The final one is actually not for regulators, that's for your owners, your farmer owners. They're counting on that audit to know that your business, that everything is being done right and your financials are right. So if that is reviewing earlier audits, that's because that's for the benefit of your shareholder members. As far as the other audits, some of which are regulatorily driven, as I say, I think proper tailoring is appropriate. We understand that. So if there's suggestions that can be made here, it's something I think would be appropriate for this committee to consider, and if worthwhile, to bring to the attention of the Commission.
Well, thank you all for the invitation to address this committee. I would like to acknowledge Krista, her great organizational skills and encouraging me to show up, and Commissioner Stump, who several years ago encouraged me to get engaged with this, with FIA at a variety of levels, and several years later, pardon me, Commissioner Stump, it's wonderful to see you in your position, and I'm excited that there are now 5 commissioners, which will lead into a statement later as a challenge to you. I have tremendous appreciation for the Commission, the exchanges, the fellow competitors on the FCM side of the business. I mean, I believe our interests are aligned to promote a wonderful business that has true economic value. We have a large employee base, a wonderful dedicated broker base, and customers that many of have been with us for decades. We're a 53-year-old FCM, wholly owned sub of Archer Daniels Midland Company, which is a 116-year-old firm. We believe in length and strength, and believe we can, through dialogue like this, we can work through the challenges that today's environment, the challenges of today's environment. As I said, I started my career as an auditor with the CME Group. I will go back further than Matt. There are 175 members of the Board of Trade, clearing members of the Board of Trade, and 130 members of the CME Group. That was 1981. After 3 years, I started a 35-year career with various FCMs, the last 29 with ADM Investor Services. My views are based on a long and at times volatile road of my experience. They're not the views of FIA, ADM Investor Services, or our parent company. There have been 3 fundamental changes in this business over the last 20 years that should be highlighted. And as a student of history, I do like to go back, think about what the changes are, and then try to apply them moving forward. The first is technology. This has affected all of our lives, every aspect of our lives, our children, our parents. An example of that is in the trading floors. 1999 or 1998, the Board of Trade built this new massive trading room. 6 months it was obsolete. A long bond literally went electronic overnight. 20 years later, 99% of the trades are done electronically. That has affected every aspect of our customers, in many aspects extremely positively. In many aspects, though, it has caused individuals to have to adjust. That is a normal cause of business. The second dramatic change, I believe, that in the early 2000s when the exchanges demutualized. For 100 and some years, it was a member-dominated exchange. Demutualization has clearly shifted the power. Although it was initially beneficial to FCMs, it's clearly changed the power structure from from FCMs to the exchanges. Exchanges have a vertically integrated business model. They control clearing, they control pricing, and the regulatory aspect of an FCM's business. The third dramatic change is the 2007 and 2008 financial crisis. 2 major changes has occurred, and it really fits into Matt's FCM slide. The dramatic economic effect driving interest rates to zero for several years changed the profitability structure of many FCMs, put amazing pressure on us. And those FCMs who price their business with an interest rate component are no longer with us. The volatility that the financial crisis caused other FCMs to withdraw. The rules that came out of that, Basel III, for example, forced the banks to recapitalize and actually capitalize futures trading. Beneficial to non-bank FCMs like ADM Investor Services, where a mid-tier customer came back that traditionally would clear banks came to us. It also changed the rules that got me very involved, which was the residual interest, the segregated funds, the age capital charge, the things that Matt dwelled on. And I have to admit, I first was extremely negative to those type of changes that occurred. I went to Washington a fair amount arguing with your predecessors. But at some point when you lose the battle, you have to, what do businesses do? You adjust your business model. And after a very rational implementation period, FCMs adjusted our model, started charging for capital, started reporting financials by noon every day to exchanges. We balance $6.2 billion of cash every day to the penny and report it. And if you're wrong, the clearinghouse, which I'm a member of the CME Risk Clearinghouse Committee, pushes back on us strongly, at times very strongly. There's a fining mechanism. That puts immense pressure on us. But when I reflect on it, that immense pressure increased controls, it increased the standardization of our process, it increased our efficiency, it increased our accuracy, all beneficial to the agricultural community. I am very confident that FCMs now are more financially strong than they were previous, 5 years ago. The reporting is incredibly important to us. So that's the history. What has it done? They've increased the cost, and they've increased the complexity of operating an FCM, thus the consolidation. Scale matters. Garnering efficiencies, gaining scale is critically important to any FCM. You need a diversified book. Diversity can be by location. It can be by customer base. But you must have a diverse book. Markets are in cycles. You can't always have a hot grain market. We haven't had a grain market in 5 years. I think CHS and ADM's profits will be good in a grain market. It's been a very, very slow marketplace. So diversity is important. I do like to study business. I do like to study history, as I mentioned. In many ways, this is a natural migration that reflects a maturing industry. I was at the CME Group when the Eurodollar started, 1982. That was only 30-some years ago, 35 years ago. It's still, now we're a very mature industry, in my mind. So, looking forward, what are some synergies that this group can promote? My challenge to the 5 commissioners, you've heard me talk about this before, Mr. Chairman, pass position limit rules, clearly define guidance and provide guidance on anticipatory and bona fide hedge exemptions. That, from our book of business, our core book of business, is a very important point. And I use it as an example. The more clarity the commission and the exchanges can provide around regulatory rules, the better. FCMs, by definition, are rule followers. The best way to follow rules is to have a good exchange, just like I talked about in the audit. Define the scope and get on with business. We will adjust our model accordingly for the benefit of the agricultural community if we can receive good clarity. My second concern, overriding concern, is around, and another example of providing clarity is around cybersecurity. I'm very concerned about it. We have challenged ourselves internally. We have a variety of protocols. It is not just resigned to our business, the futures business. It's a financial services challenge. I would appreciate input and a work towards what are the specifically defined protocols that we can protect data with. The more guidance we receive from NFA, from exchanges, from the commission, the better. And it should be done similar, in my mind, as we work through the residual interest and the segregation rules. There should be a full discussion, a full understanding of what we need, and then a time period to ramp up with that. I've actually studied when you have a concern. We have a global book. We operate in all 50 states. Some of the states have rather draconian penalties if there is a problem. That's a regulatory concern outside of our business that can truly and dramatically affect the status of an FCM. And finally, I interact a great deal with the exchanges. I would love to refine exchange services and focus on efficiency, standardization, especially around the quote challenge that customers and especially ag customers are concerned about and paying for, standardizing settlements and how they work through our system. I talked to Ed, we talked a little bit about deliveries. We've made great progress on several parts of the delivery mechanisms in the grain markets. We need some work in some other markets. That is something that for this community would help promote accuracy, promote market transparency, promote efficiencies at an FCM and at a customer level. All of these things can be done through greater collaboration, and I would hope something comes out of this discussion. Thank you for the time.
Thank you, Tom. I will now turn to the members of the committee for any questions, and then after which we will go to the phone. So, does anyone have any questions?
Robbie Boone with the Farm Credit Council, and first of all, I want to say thanks to Krista and Charlie for all your work in putting this together, and the fact that all 5 commissioners are in Kansas. I think kudos to you all for making today such a priority. Appreciate Matthew's comments on sort of where things are at with the FCMs. The farm have a little bit longer statement later, but in terms of farm credits role in all this, folks understand the credit providing function that we have, but we also play a very substantial role, particularly CoBank, in providing for the ag futures market access to funding to support the liquidity and margin requirements that support the ag futures market. I guess 2 observations that we've had with respect to the FCMs. One in particular, just simply the sheer number of FCMs, as Matthew talked about, that have exited the market that actually serve end users. We're very concerned about that. In our experience, we've seen that's actually raised the cost, fee increases, hedging for long-term one-way hedgers in the interest rate and agricultural markets, and we're concerned in terms of if those increased costs of hedging will limit customers' ability to hedge price risk. So that's sort of the first concern. And again, some of this is just environmental things that are happening, but from particularly given Farm Credit's role serving end users, that's something we're concerned about. And then secondly, and NCFC's been very active, appreciate Joe's leadership on this. Our view is that the FCMs are also restricting exposure limits to the end users because the cost of capital and issues with regulatory capital calculations. CoBank and NCFC both sent a comment recently to the provincial regulators. I think you all are quite familiar and at least engaged, at the very least on the periphery on these issues. So, frankly, if we think if an FCM or a CCP ran into some sort of constraints, problems, we're not sure there would be enough capacity for the FCMs and the CCPs to be able to timely port transactions. So, again, appreciate the presentations today and just a couple observations from Farm Credit.
Thank you, Robbie. Tom.
First of all, thank you for your credit. We depend on that every day as an FCM. There has to be this relationship that is incredibly important. Couple comments. I still look at risk positions every day. Our risk limits are set up on the credit capacity of a customer and their hedging needs on a customer, and that hopefully is done in coordination with the lender, the broker, and the end customer. We try to have a full dialogue around that. We have a rather the hog market right now is pretty spicy, and so that is something that we have interactive discussions. It's required as an FCM. So we hope that's a positive discussion, but it is an intense discussion that has to be had if you really consider risk management. Some things that you can work around it. We put pressure on exchanges to raise margins. I think they're too low from time to time. I would invite the commission study. I weigh in on that regularly and ask my team to weigh in on that regularly. But there is a symbiotic relationship between FCMs and banking. The stronger that is, and end customers, the stronger that is, the better.
Thank you, Tom. Anyone participating by phone? Commissioners, Chairman?
Well, thank you. It's been a very informative discussion, and I think that the topic that Tom and Robbie particularly touched on, the effect of the capital requirements on the FCMs and FCM services. For anybody interested in talking about this topic, this is I'm sponsoring the Energy Environmental Management Advisory Committee, and that advisory committee meeting is next Wednesday, the 17th, and the afternoon session of that meeting will be devoted almost exclusively to this issue. In the energy sector, many of the very same pressures and the very same impacts, and it's the same FCMs are providing the services in that sector, and the impact of the capital requirements, the existing capital requirements, as well as the proposed requirements of the prudential regulators and how they're calculating the capital requirements on the energy sector. The EMAC will be, afternoon session will be devoted to this very issue. So anyone who's interested in this issue may be interested in tuning into that committee meeting. But it's particularly timely that both advisory committees are having the same issues discussed and presenting views on that issue. So I think that's particularly beneficial when we have a number of these advisory committees focused on a very similar issue, and that helps provide an integrated picture and some common themes across what we're seeing.
Just a couple of reflections. Matt Colkin, thank you very much for that helpful information. And Robbie, the issue of the reduction in number of FCMs has been an area of concern for, I think, virtually every member of this commission at one point or another have reflected on that and have asked questions about it and are concerned with it. A number of the departing FCMs departed for reasons of their own malfeasance. I think back to Revco and MF Global and Peregrine and Tom, you make a good point. I mean, they may be it's a combination of malfeasance, but also over-reliance on just the a higher interest rate environment, and that's been long gone. We haven't seen anything like that since, so they've had to restructure. Tom, I found your points very insightful. Your three fundamental changes: digitization, demutualization, and the financial crisis and its impact in many areas, including availability of bank capital, consolidation, that scale now matters. The 3 points you made, requesting reg clarity, cybersecurity, and refining exchange rules, I want to respond, but I also am very cognizant, and I think our general counsel is here. You mentioned position limits. Since that is a matter that's there is a proposal still before the commission, and it's one that all commissioners have expressed interest in completing. I don't want to speak to that in a way that maybe seem to be deliberation, which we cannot do outside of a public meeting. But in terms of reg clarity, I think there too, all commissioners, I just know myself from putting rule proposals forward, every one of the members of this commission and their staffs pore over those to make sure we're as clear as possible. And I think reg clarity is something we all take seriously across the board. On cybersecurity, my predecessor, Tim Massid, captained a really very good piece of rulemaking, which is our system safeguards, which our exchanges are subject to. And I think that was really an excellent piece of work, and it has helped, I think, to help focus our exchanges on areas of cybersecurity. And I'll tell you, and I think a number of my fellow commissioners have visited our major exchanges just for the purpose of seeing their cyber protections and safeguards. And while nothing is foolproof in this world, I can assure you that certainly our two major exchanges take it very seriously, and their systems are really state-of-the-art and quite sophisticated. Again, it's a fast-moving area, and what was state-of-the-art a year ago is out of date a year later. But I think they take that very, very seriously. What I want to say for our own self as a commission, we also take it very seriously. As a chairman, when I think about cyber risk to our markets, I think about it in two areas. I think about it, the risk of our market participants, but I also think about it, our own agency vulnerability to risk. As you know, we take in a lot of data from our markets, and I'm sure that market participants who contribute data to us are concerned about how it's handled. In the last 2 years, we've conducted 5 major agency-wide drills, not just in Washington, but also in Chicago, some with our exchanges, some with fellow regulators. We have one upcoming jointly with the SEC to test our own vulnerabilities in systems. And again, just like the exchanges, nothing is foolproof, but I point that out just as a way of hopefully giving you some sense that we also take it very seriously, not just for the marketplace, but for ourselves. And then finally, on your last point about refining exchange rules and operations and interactions, one of the purposes of this conference is to provide a neutral, independent, but highly data-driven forum to look at issues alongside our exchanges, issues of convergence, operations, data processing, others, all the things that are on this year's agenda, last year's agenda, and will be on future agendas, to have a conversation that is open, is public, it is good-natured, but it is looking at real data in a very professional, shall I say, adult way, to have a conversation and to see how we can make these markets more efficient, more better, and how users of our markets and operators of our markets can better coordinate and speak to one another and hopefully improve markets as we go along. So hopefully that's one of the purposes served at a conference like this. It's also one of the purposes served at advisory committees like this. So once again, thank you for very good points. I just wanted to give you those reflections back.
Commissioner Minim, you have any?
I'd quickly follow up on the cyber comment. Tom, you used the word protocols and guidance, and this is not necessarily a question now, but I think as the committee deliberates, and if you want to unpack this issue more, in my time as a commissioner, I've actually found that there's certainly engagement across the board on wanting to have a cohesive conversation about cybersecurity, but I think some folks might resist necessarily too much encroachment or too much oversight from a regulator. I don't necessarily agree with that. I do like the way you framed it as a sort of more inclusive conversation about how we're going to protect our financial markets and then to an extent national security from a cyber standpoint. So I would welcome and be interested in a conversation about what you think would be a way that this agency and other, both state, to an extent local, but also most importantly federal regulators can be helpful, can work with market participants to have a more sort of across the board cyber plan. And I don't know if that is guidance, if that is just a set of protocols or it's something more or something less, but it's good to hear that because I definitely hear, not necessarily the same theme from all market participants.
Yeah, just briefly, it is defining protocols that FCMs would follow. I agree the exchanges are well versed and have invested. I've met with them around their cyber policies. We need to go further down the line, and we would do that through similar to what we did in 2014 with residual interest, define it, and why? So customers don't play FCM. The change of culture, meaning that we have to require good customers that don't like to change the way they receive their statements and the way they access data that is not necessarily cyber safe, if you will. That would be very beneficial. Then all exchanges then make up their own mind and how and when in the process, because there's so many, we've studied this, there's so many different ways to protect data. Coming into a portal, sending it protected, you rely on the FCM to protect the data based on the timing mechanism that NFA or the Commission would enact. But happy to talk it offline.
Thank you. Commissioner Quintens?
Yeah, just quickly to follow up, I think everybody on this side of the table has at one point or another said that cybersecurity is the biggest risk facing our markets. I think it's also one of the biggest challenges from a regulatory perspective. I think it's an area that really needs to lend itself to kind of principles-based regulation. Otherwise, rules can become out of date very quickly. Advancements in technology cannot be incorporated. But that then leaves a challenge for those regulated entities to try to understand what they need to do to be up to date with the strongest advancements. And Tom, I think you're absolutely right that more conversations can probably lead to better guidance and better understanding on our own parts. And at least for my part, the Technology Advisory Committee that met 2 weeks ago did give an opportunity for the Financial Services Sector Coordinating Council to present its cyber profile that I thought was a really interesting way for the private sector to develop a blueprint that had a lot more detail and had a very good approach to calibrating how to look at cyber exams or cybersecurity compliance. And if there are better ways that we as a commission can use things like that or get the experience of the private sector to calibrate.
I'll follow, and it is being audited by NFA. It's being audited by our public accountants and our ADM's internal IT group that does audits internally. So there is something in place now. I'm for refining it and further refining it and strengthening it. I appreciate your comments.
And in fact, we worked with NFA on that. So there is very, very good dialogue. Sometimes it's not readily apparent to the public, but there is very good dialogue on this.
Okay, thank you. And Tom, I can't speak for the chairman or the other commissioners, but I do like spicy pork. Maybe not a spicy hog market, but spicy pork. Anyway, the AAC will take a 10-minute break, and we will resume at 9:45. Thank you, panel, for this wonderful discussion. I would like to call the AAC meeting back to order and begin our next panel discussion. With us today to talk about technological innovations in the agricultural cash markets and the role CFTC can play in those spaces are Jim Hennigan, Senior Vice President for Agribusiness at Grow Intelligence, Jay Frosizer, Senior Vice President of Financial Analytics at DTN, and Mark Pryor, Chairman and CEO of The Scene. And I'd like to remind, please remember to introduce yourself before you speak into your microphone. Thank you, and I'll let you begin.
Thank you, Charlie. I'm Jim Hennigan. I'm Senior Vice President for Agribusiness at Grow Intelligence, based out of New York. I'm very happy to be here today. I want to thank the commissioners for inviting me and Grow Intelligence on behalf of Grow Intelligence. Very happy to be here today to present to the Agricultural Advisory Committee. A big thanks to Krista and the staff as well for setting this all up and arranging for us to be here today. Very excited to be on the panel with Mark and with Jay, who we know through the industry and the trade. Been asked to give a little bit of an oversight and overview of agricultural data and how agricultural data might be used for innovation in cash markets, financial markets, and then try to get to how it might be useful for regulatory purposes as well around those markets. And I'll get to that in the presentation. Want to get a bit into what Grow Intelligence is, just a bit of an overview. So we're an agricultural data and intelligence company. We do aggregation, dissemination, normalization of agricultural data covering grains data, oilseeds data, sauce data, livestock data, dairy data, fresh produce data, covers anything from climate data to production data, consumption data, trade data, price data. It's global in nature, largely public data. We do license some data. We'll get to that a bit. We've licensed DTN data recently, so we're happy to have DTN in our data platform. But it's largely public data from government agencies and organizations. Our business is with a mission behind it to take all that data and hopefully democratize the data access for users and clients of ours. But when we say users, we mean anyone from farmers to producers, cooperatives, consumers, food companies, seed companies, nutrient companies, merchants, traders, financial traders, physical traders, technical traders, banks, lenders, other parties, academics. We get engaged by universities, academics, NGOs in data that we provide. So we have an overarching mission of trying to provide agricultural data out there in a democratic way. That's the ultimate mission for our business. The current business that we're in the for-profit business, commercialization of our business, is large enterprise deals for agricultural data that we provide through an application programming interface, an API. We provide data through a web application, and that'll be accessible to all the people here on the committee, and for anyone that wants to log in the webinar, they can see that. We've provided public links for the data. What we feel the purpose of the normalization effort, give the example of the USDA does a great job in providing agricultural data in all different types of areas, commodities, facets, all the respective agencies from USDA NASS to Farm Service Agency, Foreign Agricultural Service, ERS. The USDA does a great job on its own providing agricultural data, but it's in the different respective agencies, and it's not fully normalized and available to all the end users in a really accessible way. But they're probably the best, and they do a great job overall. But we take a lot of that respective agency data and then bring it up to a common platform, and then we do that with other government agencies that don't do as good a job as USDA does. Statistics Canada, CONABI out of Brazil, Argentine Ministry of Agricultural Data and Statistics, Chinese Statistical Bureau, SSB, or National Bureau of Statistics. So we do it globally across all these agencies. We take data from NASA, from European Space Agency for climate data, and then scrub it, make it accessible on the platform, and then it can be used on a web application or a data feed for the enterprise deals I was telling you about earlier. So this gives a little bit of an example of what we do with it. With the API, we solve enterprise problems for clients. We combine the data. We do our own analysis. So our team, we have a lot of developers both in New York and actually in Nairobi in Kenya. We have a team of developers in Nairobi. They do the work of mapping the data, organizing it, disseminating it on the database and in the web application. We have analysts on top of those developers putting the data together and combining it to try to put out different data analytics for users, clients, and then we put some out for public consumption as well. We have a content function, so we get engaged by journalists, anyone that wants thought leadership in some way around public data. And we use the web application heavily to have that collaboration and discussion with users. This is the list of the companies that we go through. I think I ticked off most of those, going through the different types of companies. So we engage different clients and people in a lot of different ways in all these categories along the agricultural supply chain, which is well represented by the committee here from what I see in here. I put in the hyperlink here, the data coverage that we have. We have over 100 sources. We're adding more as we go. As everyone probably well knows, there's all kinds of agricultural data out there. It's in varying shapes and forms. Some data is readily accessible. Some data is easy to get. Some data is not so easy to get. How do you go get a data set that might be in a PDF in Mandarin and convert it and then put it on a database to make it easy to use versus data that comes from an API from a vendor like DTN, a business like DTN that has a great underlying database and data set to pull from. So how do you make those two data sets work together in one place? So that's the challenge that we try to tackle, and we do it across all these agricultural data, crop country pairs, as we'll get to, and I have some of the links in the presentation later. These are the main data issues, and I think this is where I'm going with the presentation, how it might be worthy of the advisory committee and maybe useful for all the underlying businesses that you guys represent and for regulatory purposes ultimately too. Spreadsheets are hard to manage. There's a lot of legacy data files out there in the agricultural world. I've used a lot of them. I've lived it in different roles and capacities in my former companies. They're disparate in nature. They're difficult to combine and analyze. The data is in a lot of different units, frequencies. It can be very granular. It can be very macro in nature. But once you get your hands on data, what do you do with it? How do you update it? I mean, even if you get it all together, then the task of updating it is a difficult task. Nowadays, with data availability, with technology, the cost to get the data, the access to the data is easier. It's faster. To store it is much cheaper. We're in that business of trying to put that all together as an overall business model. And try to tackle that large scale and scope of agricultural data across all the crop country pairs that you can imagine that are out there, and there are many. This gives a little bit of idea that how do you go about identifying data, mapping it, integrating it. This is our example of it, but it's what we feel is part of the innovation out there. You try to normalize all the data and taking advantage of all the different capability that's out there to normalize the data, to use different things like optical character recognition to try to take a PDF and convert it into a time series of data, use different data tools out there. And this is probably the thing about big data or artificial intelligence or machine learning, things like that you hear kicked around a lot. We employ a lot of the tools that are out there. We're not necessarily innovating on all those fronts. We're using a lot of those tools and innovating using the tools that are available to us. And I think that's a common theme that should be pushed with the commission, with other participants in the committee. There's all kinds of tools out there that can be employed for taking good data that's out there and making it readily available and accessible. And a lot of that data it's public data, it's neutral data, it's unbiased data, it's government data, and that's most of the data that we take, and we try to purvey that in a strong way. And I think all you could do the same thing. There are tools out there that you can harness to get better access to data, combine the data, and not struggle with as much as I think a lot of people struggle with over the years. This is just one example I gave, relevant hopefully to this community, combining CFTC commitment traders data and CME data, price data. This is in our web application, but it's just an example of a combination of data sets. So in a time series, this is on our web application. The data is in our database there, so users could go harness the two data sets and look at, in this example, managed money positions, gross longs and shorts for soybeans versus soybean price historically. Just one example of combining data. How do you make it a useful, actionable item with a visualization tool or a data set that someone can go do analysis around or think about the scenarios around positioning and price. Next slide. This is a snapshot of the coding behind that. So on the left side is the code, the Python script that was written to pull the data off our database and aggregate it in a way and then show it with a simple output on the right side, which is just an Excel spreadsheet of weekly price and positioning. So it's an example of what you can do with the database and try to run scenarios between COT positions and price. And then kind of get into the punchline. Hopefully this is, maybe we get some questions around this. What can you do with the data out there that might be useful for the advisory committee, might be useful for the commission? Replacing spreadsheets for sure, combining multiple sources of data, that's all doable. Getting into things like deliverable supply calculations. I mean, there's a lot of older spreadsheets out there that are hard to manage to combine to try to get to that deliverable supply calc that goes behind the speculative limit and spot limit calculations, all month limit calculations that I'm aware of. You can take data to look at physical and futures price convergence. If you've got a nice rich database, I think it makes it easier for people to look at the historical performance convergence around specific futures contracts and the physical prices out there around them. I think you can do things around futures delivery calculations, combine cash data, combine futures data, and look at the delivery calcs to understand whether a cash market is above or below delivery. Does it make sense? Around those calculations, is it updating in a way that's useful for people looking at those calculations? And I think you can do it across all the enumerated commodities that are out there. So I think this is not an effort that would just be exclusive to doing on grains or oilseeds, and you'd spend time looking on multiple fronts. I think you can do this across all the enumerated commodities in scope for the commission. So that's what I came here with to speak about. Try to get to what we're doing as a company, looking at agricultural data and innovations in tech and applied to the agricultural space, could benefit for us as a business, but I think there are a lot of things out there that we're doing that could be beneficial to the committee, to the commission, and to use these data tools that are out there to make things more interpretable, easier to understand, fewer man hours on data, and more time and analysis and thought around the data that's out there, largely out there and neutral in nature. So thank you for the
Jim.
opportunity to speak.
Does anybody have any comments before we proceed to the next?
Jim, I just had a quick question.
Please.
The data that you receive is probably only as useful or reliable as the way it's collected.
Yes.
There are probably, just as there are differing formats, there's probably a lot of different processes by which the government collects data. Do you take any views as to the scope of that reliability given the various processes that the data is collected by the government?
We do. It's something that we take a lot of time on in terms of when we map a data source, we look at it, how often does the data come out, how frequently does it get updated, what revisions when might there have been revisions to the data, were the revisions, were they corrections in nature, or were they just bad data to start with and then got replaced with old data? So we're always going back and looking at the integrity of the data, and some sources are really good about replacing data or making corrections, explaining why they did that, and we collect that in metadata. Other sources are very poor on that, so you overlay data, and then we actually have to start doing analysis around that and say, okay, here's some insight around this particular data source. They update the data, and then they don't explain to you why, and maybe you can do some analytics around and come to some conclusions around that through a robust data process and having that integrity and the look on the database to say, this is probably a data source that doesn't have the integrity, and you can see and quantify that, whereas another one will. So yeah, we spend a lot of time on that. We don't try to critique the source so much. I mean, I think that the data will prove it out. So we can do the metrics around that, and I think the people that look at that can make their own conclusions on it.
Chairman.
Thank you.
Jim, I know we had an interesting conversation yesterday at the CFTC's offices here in Kansas City. You were talking to me about our own COT report, which we put out, and that you've taken a good look at. And during the government shutdown, as you and many know, the COT report was discontinued, or at least paused until we reopened. And you talked about efforts you had done to somewhat replicate it, and I'd be interested if you might share that with the other advisory committee members and the commissioners.
Yeah, it was a great conversation last night on that, and we're talking about during the shutdown how a lot of the agencies that weren't providing the data at the same frequency they normally provide for public consumption for all the participants in the agricultural markets to use that data for managing risk and making good judgments wasn't out there. And we saw this across all the agencies. NASS was not up and running for major crop reports at the beginning of the year. CFTC COT data wasn't out there. Foreign agricultural service data for export sales data wasn't coming out. So we ran metrics back we looked at prior government shutdowns and said, okay, in prior government shutdowns, what was the delay in the data? And then when the people got back to their jobs and started reporting data, like what would you expect in terms of the catch up on the data? So we did some data work around that and some analytics. We put it out for public consumption. We took a very ambitious step, and we didn't want it to be presumptuous in any way that we thought we could replace the work that the USDA does, but we took an effort of putting out a WASDE-like set. We put a grow agricultural and supply and demand estimate on schedule without the World Agricultural Supply and Demand estimates and the Outlook Board providing that data from the Office of the Chief Economist. We did that on schedule, and it was a lot of work for us to go and try to follow a process that a lot of the hardworking people at the USDA do and come up with the underlying data and then put it out in a format that everyone could follow that was neutral in nature, wasn't biased. We're not trading off of it. We're a data company, so that we felt that people could take that with a lot of confidence that it was a reasonable data set in a time where there weren't a lot of data providing from the different agencies. So we did that, and then part of that was COT data as well. I think we put metrics around that just to say, the catch up when you start seeing when the positions start coming back out, this is what to expect. So, we did a lot of work around the shutdown around that, and it was an effort that we think we can continue on where it's systematic in nature once you get to the point of calculating data and putting it in a very objective, formulaic way to produce those reports off of trusted sources. When the sources are out there, it's even better. When they're not, I guess it kicks in, and it's very helpful for a lot of people that are looking for that data and guidance.
When we resumed publication of our COT data and got caught up, did you find any interesting discrepancies between your bridge data and our final data?
Not that I'm aware of. Nothing I've seen that. I think it caught up well, and it was good in nature, and the integrity was quite good. So no.
Thank you.
Thank you.
Okay, thank you, Jim. Jay?
Hi, and thank you. Sorry for the delay there. My name is Jay Froshazer. I'm with DTN. I'm our Senior Vice President of Financial Analytics out of Omaha, Nebraska. So first I'd like to thank everybody, Chairman, the Commissioners, the Advisory Committee for having us. My presentation is going to be a little bit different. I apologize as I go between slides. I've got a little formatting to do. Our slide presentation here is we like to do things big, so I have to resize things a little bit on the fly here. But again, I'd like to thank everybody for having me. Jim, as you said, we're a data provider, and I'm going to provide a little bit of information showing what data we provide and how long we've been doing it, but I want to bring it into more of a business context around cash transaction, the cash grains data, and then the execution of that cash grain market into the elevator for the buyers, and also the hedging that goes on into the futures market through some of our products. So just to start, I think a lot of the people in the room are familiar with who DTN is. We've been in business in fact, we just celebrated our 35th anniversary, or birthday, if you will, here on the 9th. So we've been in the information providing business for 35 years. We got our start in agriculture. It's grown into more businesses. We provide a lot of information and data services around energy. Weather is a big business. We're the world's largest commercial weather provider globally. Obviously, weather is a big impact on the agriculture markets, so having over 100 meteorologists on staff, an agriculture weather network, weather stations in field with soil probes, providing information in real time to drive not only current conditions but forecasts and historical information that can then be used in our models on the meteorology side. The financial analytics side of our business is more taking the data, disparate data from different sources, analyzing it, giving it to our customers in a client application or in raw data form so that they can make decisions on their own. But at our core in the agriculture space, DTN was founded on being an independent and unbiased source of information. So we have also one of the largest agriculture newsrooms focused on the producer, always have. We started as a very technology agnostic company. So while we're here talking about innovations and new technology, the fact is we're agnostic to technology. We started by providing information via an FM sideband to a monochrome displayed system that a producer could receive information through. That expanded into satellite transmission as the technology advanced, color screens, real-time information onto the internet, and obviously now mobile. So as technology changes, we're here to embrace that technology and continue to allow our customers, allow DTN to be the independent kind of middleman to bring our customers together to continue doing business efficiently. So as we talk about our cash grains data, we really sit in between and provide services on both sides of the transaction. So again, producers who are using our information services to get an insight into the market. Our newsroom is doing analysis on government reports, technical analysis, fundamental analysis. They're providing that insight to our customers, not creating buy-sell recommendations necessarily. We're not brokers, but we're providing advice on what we see in the current, the historical marketplace, and how that might impact the future. So we do that through products called, for example, MyDTN, which is a web-based product that producers subscribe to. We do, by the way, still have thousands of customers receiving our information via satellite. So, as the rural area internet communications continue to get better, a lot of those people are moving to our internet-based products, but we still are use satellite as a core distribution mechanism for information out to rural areas that don't have as good a broadband internet connections. We also just released a product called the Grain Marketplace, which I'll go into a little bit more detail on, but it's a free application that allows producers to manage their inventory of grain, set goals and objectives, manage that in the palm of their hand, and then ultimately sell their grain through their relationships. On the agribusiness side then, we're providing web hosting through our AgHost product. So we host over 1,000 websites for agribusinesses, primarily grain elevators that not only need to better communicate with their customers, they need better technology. We help them provide that. But it's really about keeping that strong relationship while people are out doing their own research now on the internet. Aside of that, AgHost business is our portal, which is a grain trading portal that allows producers to post their offers and for those offers to be accepted by the grain buyer. We take a lot of the complication away, a lot of the spreadsheets and manual processes, and allow those elevators, those agribusinesses, those buyers to then hedge their position in the futures market automatically. We do all this 24 hours a day, so as the markets change, as information is released, people can make decisions. They're not beholden to their normal 8 to 5 or sometimes 6 a.m. to 6 p.m. Time frames. So why is this important? Obviously, the market continues to be dynamic. Competition's increased. Grain buyers need to stay competitive. They need to stay in touch with their customers, the producers. The producers need to stay competitive. They need to maintain their margins and stay up on the markets and make sure that they can get the margins that they need out of their crops. So as technology changes, the margins are tightening, consolidation in the industry, volatility, again, the 24-hour aspect of the market. We're here to make sure that that all stays together. So to give an example of that, the ability to act 24 hours a day. So I apologize, the chart's a little hard to see on the screen there, but this is just an example of corn prices and opening now, Sunday afternoon. The impact of the market if a producer was not able to put his offers out when we'll use the example of the president tweeting about trade, and this happened, I believe it was December 2nd in the evening. There was significant anticipation that was going to have a market impact. Our producer customers were able to go into our portal, put their offers out there, sell grain. Those offers were accepted through preset limits. They were able to transact overnight, and the agribusinesses then are able to hedge that position automatically in the market as well. So again, not limited to the regular business hours. They didn't have to wait until business opened Monday morning. The phone lines didn't have to be jammed. They didn't have to scramble to update spreadsheets. So as it relates specifically to the cash grains data, so DTN is the foremost producer of cash market information through these products. Example here of our GIS-based cash grain information. Not only have we been providing this information to our producer customers since the early 90s, but this data has become more and more in demand by market participants everywhere, all the way up to the speculative trading market. We currently collect approximately 42,000 locations of bids. That equates to about 35,000 bids on a daily basis. And we do that with some old school technology. We still have a staff of people that are placing calls to elevators to get their current pricing. But a lot of it's coming in electronically as well now through, again, our hosting platforms and our portal platforms, where the elevator is posting the prices and now able to not only what used to be posted once a day, they're now able to post multiple times a day. We have historical data going back to the early 90s, and it includes basis, spot, and forward. What we're doing with this data internally then, our analysts take this information, mash it up against other data sets. We have our ears to the ground. We're talking to producers every day. We're talking to the industry every day, and trying to kind of come up with the so what of what does this information mean, and as basis changes, why is it changing, and what the effect is going to be for the future. So again, an example here, just a few screens of how customers are utilizing data. Very similar, Jim. In fact, commitment of trade or USDA data, the elementized data, we do some of the same types of things, and again, bring that data into an interface that customers can choose how they want to interpret the data. We try and provide some guidance and some answers for the future, but in the end, we're providing information and education for the industry so they can make their own decisions. So again, one of the big pieces too is the ability to bring in proprietary data. So an elevator, for example, might bring in their customer record information and bring that into the platform, be able to analyze the cash pricing and its movement, and determine how that is changing the customer psyche, the producer psyche over time. And again, we also, again, not being beholden to any technology, but we do, as this data has become more in demand in a raw form, we provide it via APIs as well. So just I've talked about a few of these, so we'll kind of burn through this, but our Ag Marketplace app, again, it's a free app. We released it earlier this year, so it's new. It's for the producers, and it really just allows them to manage their cash inventory, see the markets in real time, see what's going on, not only with the futures markets, but the cash markets, some of our weather data, of course, as well. But it facilitates their ability to sell their grain and manage their position over time. So if they set their goals, if I want to contract 25% now, 50% later, it's going to look at different criteria in the marketplace and give them alerts when their conditions are met. When those conditions are met, they can take action on it through the app. So we boil it down to, providing a producer the ability to know what to sell, when to sell, and where to sell it. While there's a lot of kind of disintermediation and disruption going on in the industry with technology, we are there to provide a channel for the producers to continue working with their retailers, again, the agribusiness that they've had relationships with for decades. We're there to facilitate that, not disrupt that. So we, again, maintain our independence and unbiased nature there. As it carries over then into the elevator, the merchandising aspects and the hedging side, I won't spend much time on this, but the real key message here is the past is kind of a mess. It's spreadsheets, it's telephone calls, it's going in and manipulating multiple systems when you need to change basis or the markets change. We're trying to address that, make things more efficient. Again, boiling it all down so that those agribusinesses can get back to what they're doing, what they've always done best, and that's serve their customers. So we do that by providing them the digital communication tool, operation tools, that Ag Host portal that I've already talked about. With our Ag Host, again, the real key there is providing an ability to communicate to the customer and set those prices, set that grain price, update it multiple times a day, push a notification out to the producers through email, text messages, push notifies through apps, so they know that something has happened intraday that they need to be aware of. And then the portal side, again, as I've been discussing, is it's about executing that transaction 24 hours a day, taking offers. We're currently transacting over 5,000, or actually executing over 5,000 offers on a monthly basis. And obviously continues to grow as more producers adopt the technology, as the agribusinesses are there to accept those offers, ethanol plants, anyone who's a major purchaser of grain can now increase their communication and their customer service with the producer community. So that's the prepared slides that I have. I look forward to any questions if I can answer them, and otherwise, we will also then turn it over to Mark.
Thank you, Jay.
Thanks so much, Jay. Appreciate the presentation. The CFTC, our economists in our market intelligence branch, have done a lot of work looking at some significant price moves across different contracts, and I think they're going to present some of that research tomorrow. And what we've been able to find is that a lot of those price moves have, I think expectedly, been around USDA release, important USDA releases. USDA has recently changed their process for releasing some of those reports, I believe. Are you involved with the subsequent push out of that data? Could you describe whether or not the changes they've made have had, in your view, either positive or negative impacts, and just give us some color as to how you view those affecting the marketplace and the transmission of data?
Yes, absolutely. So DTN has been in the lockup of the USDA for years. So we've received the USDA reports. We prepare those reports. We boil them down into terms that our customers can understand, both short form and long form. So we've looked at it in two ways in the past, and that is trying to get the information out as quickly as possible, because those reports do move the market, but at the same time also getting our analysis written so that we can boil it down to our producer customers that maybe they're not looking for a real-time trade, but they want to know as quickly as possible and in their terms what it means to them. With the lockup going away and the dissemination of the data now via the web and in more or less an automated fashion, we've had to, I would say we're lucky in that we had a dual receipt capability already within our company. So not only were we preparing our reports in the lockup sort of manually, we had editors there working on it. We also had backup mechanisms to automatically pull that data from the USDA website when they were released. Timeliness being one of our priorities. So I feel like we're one of the best at getting that data out as quickly as we can. So when the change came, there was a lot of upheaval in the market, and it had a negative impact on our ability to release information quickly to the ag industry. Obviously, throughout the industry, I think we have a long history, and we've been doing this a long time. So we have a lot of people that listen to what we have to say in our analysis around it. So it does impact it. We're able to get the data out, the flash report very quickly in an automated fashion, but then our editors have to scramble, our analysts have to scramble to do the analysis, and that takes minutes to a half hour, and that has a negative impact for sure when the market has already moved.
Thank you.
I don't have a question. I just have a comment. It's amazing how far this has advanced. When I was in college, I used to go to the grain elevator to do research at the DTN, the monochromatic screens, and it was really, this is fantastic. I so wish I'd had an app. It would have made life so much easier.
Okay, thank you. Mark with the SEAM.
Thank you. Just like to say thank you to the Commission for inviting the SEAM to present on innovations in spot marketplace. Thanks to the committee, members, and guests. It's one thing with ag. If you eat food or wear clothes, you're definitely impacted by agriculture. So thank you for that, and everyone is. The SEAM is a company that's based in Memphis, Tennessee. We were formed in the year 2000 by some of the world's biggest agribusinesses. You would know the name. We're a private company, and we work with the industry very closely. The American Cotton Shippers Association is a member of the committee. The National Cotton Council is a member of the committee as well. And we've been very fortunate to provide trading and technology solutions for the commodities market, particularly cotton. So if you look at the SEAM and you compare it to the futures market, ICE handles the cotton futures, the cotton number 2 contract for physical delivery, trading the March, May, July, Oct, and DEC, whereas the SEAM handles the spot market, the cash market, U.S. cotton, physical delivery of electronic warehouse receipts in a warehouse. So that's the contrast. We're very complementary, working very closely together for the hedging needs that you would have in the spot market and the future side. We just reached our millionth bale traded on the SEAM for this season. We trade about between 1.5 million to 2 million bales, give or take, depending on what that year holds for us. But we just reached the millionth bale on the platform. Cotton, just to kind of give a little bit of a background, is an identity-preserved commodity. So every bale of cotton is unique. Although they may sit side by side in a warehouse and look identical on the outside, they're not the same in value. They're not the same in quality. Cotton that may work for blue jeans is not necessarily the same cotton that would work for a fine linen shirt. And it's very similar to a car, where you have a vehicle identification number that represents a car. 2 Toyota Camrys, they're both blue, both same model year, but they're different. And you can imagine with identity preservation, IP commodities like that, there's a lot of innovation that goes on about the logistics, about the management, about the movement of those commodities. And the cotton industry has done a remarkable job to bring those efficiencies to light. Another remarkable innovation happened in the mid-90s, but let's look back at warehouse receipts. These bales that are unique and in a warehouse are represented by a negotiable instrument, a warehouse receipt. In the years past, it was a paper document where the holder of that receipt was entitled to the goods in the warehouse. You can also imagine how that might have presented some complications not that long ago, where if you needed to ship cotton, you had to FedEx receipts around, or better yet, since they're negotiable instruments, you had a lot of folks on a plane with briefcases full of these, right? And in the 90s, they came out and said, there's got to be a better way. And it wasn't that long ago, but 1995, they came out with the electronic warehouse receipt. And that allowed some incredible innovations. You could now do things like trade during the day. The same bale could exist in a warehouse, very unique bale, that can exchange hands multiple times without physically moving. And it allows for marketplaces like the Seam in this case to provide anonymous trading, where we are the buyer to every seller, the seller to every buyer, and the collateral instrument is an electronic warehouse receipt. Makes it very efficient, very easy to transfer ownership. And we clear, I guess, it's about $500 to $600 million annually. We're just talking about cotton here. So it allows the markets to provide some very strong efficiencies in the marketplace. This data that results from these trades online is made publicly available. So talking about price transparency, as Jim and Jay were talking about earlier, this information is available in real time. So as this information, trades are conducted, it's made publicly available for those to look at not just that a trade happened, but what grades, what qualities of this cotton are transacting and at what price in real time. Now, a large amount of this data is sent and made available to the USDA for their spot quotes, and therefore made available for businesses to do their mark-to-market analysis against their inventory. So it all has been working very well in this nearly 20-year span of transparent information. Not all cotton trades on the seam. We wish that wasn't the case, but there's futures forward contracts that a large majority of the trades are conducted under. This is just spot trades, cash trades. But there's some new innovations. If you pick up the paper, there's certainly a lot happening in ag. Now, the first step to recovery is admitting you have a problem. I'm a software guy. I'm admitting that. And looking at what's happening today is so much more, there's so many more possibilities than what was happening at the early days of the internet when I was a software architect. And it's incredibly exciting. There's some new possibilities, and I'd like to just share a few in the few minutes that we have to talk about. So in looking at this warehouse receipt idea, going back for the paper, when it was paper, moving to the electronic side in the 1990s, mid-90s, really, they were innovative before they knew this buzzword called asset tokenization, right? Asset tokenization is simply an abstract instrument that represents an underlying asset. That's what they were doing. They were doing it with paper. They were doing it with electronic receipts, but it was centralized, right? The paper was centralized to the warehouse. The electronic receipts are centralized to a private organization that's running those. But the version 3.0 is much more exciting, particularly coming from a software guy, right? So 3.0 looks extremely exciting, and I'd like to just talk about a few points that make it exciting for me. So if you dig into these distributed ledger technologies that I'm trying to stay out of that as much as I can. I would love to talk more about it, but that's the exciting part for me. There are concepts called non-fungible tokens. These are electronic abstract representations that are unique to a commodity. Remembering back a few slides ago, every bale of cotton is unique. It has its own characteristics, its own identity. It makes it perfect for this environment. Distributed ledger environments to promote decentralization. We're moving into a decentralized, we're moving into a distributed world with this technology. And it allows us to move beyond the walls of a warehouse, where a warehouse is where the electronic receipt kind of works. It only works when the bales are in a warehouse. But if you think about cotton, it's in a constant state of motion. It's on a truck. It's on the rail. It's on a barge. It's in another country about to be made into yarn. And what is needed is an electronic representation of an asset as long as that asset exists. So as long as that bale is a bale and is not turned into a shirt, it's trackable, traceable, tradable. So that's what we're excited about, and we're working with some other possibilities that you may have heard about with smart contracts. So now that you have this capability with tokenization of an asset electronically, you can do things like automated transfer of ownership when certain conditions are met. And to me, we're just about to get into this interesting era. So we're working with the National Cotton Council, and they have just announced partnership with the SEAM to provide a platform for farmers to provide their claims, their proofs, their attestations about sustainable farming, where they're enrolling and providing self-assessment questionnaire information about how they are good stewards of nutrient management and their water management, crop protection, all this information. Now, the result of that is the bale. The bales that are actually produced on farms that are enrolled in a sustainable production platform like this have a unique value. They have a unique value to the brands and the retailers that are out there that are demanding it. They're demanding to know that the cotton is sourced and produced sustainably, but more importantly, they're interested in the journey of the cotton. Where did it come from? How did it get here? They want to know. They want to know that journey of the bale going from the origin, ginning location, to maybe another consolidation area, to another textile manufacturer. They want to know. They want to look at that digital crumb trail of the bale. And that's what we're excited about providing. Now, moving into another area, we've been talking about data this morning. Data, data, data. We know we've got mounds of data. In fact, a good statistic is this. 90% of the data in the world today was produced in the last 2 years alone. That's a startling statistic. And we know that that's only growing. It's growing every day. Where we have data at our fingertips, it's growing mounds and mounds and mounds. So I mentioned a new protocol that's being heavily adopted in the software developer community. I'm speaking again with my software hat on because that's what I love. And it's called IPFS. It is not a software product. It is a protocol that is set to change the way files are received and retrieved on the internet. You have HTTP. You may have heard that. You key that in at the beginning of your search query, but you may not understand what it is. It's basically a protocol that allows this interoperability of data. IPFS stands for the Interplanetary File System. Kind of a crazy name. These are nerds. But it fundamentally changes the way data is transferred between parties. So where HTTP, we're getting in the weeds, this is agriculture, HTTP is very centralized. So you ask for information from one location, whether that location is in Kansas or Memphis or China, and it returns this response from that computer. We're moving into a world where you ask for the content itself, saying, give me the content that is represented by this digital fingerprint, by this hash, they call it. I won't get into the technical weeds too much. And that's where the excitement lies. So let's just look at something called this book, War and Peace. We all have heard about it. Let's say it was digitized on a PDF, 1,225 pages, 587,000 words, can repeatedly produce a fingerprint that is fixed length that represents that content. All right? Now, that's where the secret sauce of things like blockchains come into play. But it's also very interesting for just large data sets where you need to make these available to the industry, whether that's weather data, whether that's market data, information that the entire industry needs that doesn't have to be duplicated, but assures you of the integrity of the data itself. Now, if we were to go and change this PDF document and put a period on page 582 after a sentence, an extra period, it would change this entire signature, this entire fingerprint of the document, invalidating the contents. So that is all baked into the product. So again, large file distribution is perfect for this. The data assurance and the integrity is part of it. So the content and its fingerprint are you can't change them. High performance, massive bandwidth savings. We've got broadband today. We've got all these high-end networks. But when you're duplicating information and everyone is making copies of it and trying to access it in different ways, it does slow down things. And we have to be mindful of the 90% of the data is created in the past 2 years alone. Peer-to-peer, distributed persistence, but we see this as being a major factor going forward for software that's going to be built under a decentralized, distributed nature. There's also something to clarify is this whole idea of contracts. And a lot of people have this misnomer about smart contracts. They think when they hear contract that it's a legal thing, and it's not. And this is used in conjunction with distributed ledgers. But a smart contract is nothing more than just a software application that's designed to do something based on an event that triggers it. What we really are thinking about initially when we think contract, and maybe that's where we're going, is what's called a Ricardian contract. And this is a digital agreement between one or more parties that is both human readable and machine readable. So we're used to working in a world of PDFs where that's what this is the contract we had, and we have this electronic signature and we can read it and use it. But we haven't worked in a world where we can digitize the terms and conditions of that agreement. We haven't. And a smart contract doesn't do that, but a Ricardian contract is really what it should have been called all along. It really should have been what the smart contract was referring to. So we're excited about working with this environment, but it's totally built on standards that the industry comes together to define what a contract is and what its various components mean and how you might be able to provide some automation with computerized technologies in software. And user experience matters, just in closing. You don't necessarily need to know how electricity works to use the light switch. You just want to use the software, and that's what the industry's focusing on from a software standpoint. And just like reminding us of the beauty of the Internet existed a long time before you could go on Amazon and buy something, buy now, send it to my Prime account, which I have several at my gate, unfortunately. It was available, but it was available to the guys with the green screens in the back room that says, oh, this works totally fine. And it wasn't until we had this abstraction layer brought about by Internet browsers that it became mainstream. And I'll just say this movement that we're seeing now in this new technology using distributed ledgers, asset tokenization, and more is being abstracted very quickly, and I see it coming to market in a remarkable amount of time compared to what the Internet did. So we have a lot going on, not just in the spot market. We've been building upon years of success with what we've done at the seam with trading, web-first technology, but we see this wave coming, and we are getting ready for it. And thank you. Appreciate it.
Thank you, Mark. Very interesting. Do we have any questions from the members of the committee?
Sure. Darrell Blakey with NCBA. Mark, thank you for your comments. I think it's really innovative and really refreshing to hear about this tokenization of assets across the commodity space. Do you see this transitioning outside of cotton as well? And then also within the cotton industry, you mentioned foreign markets. Are you concerned with China, India, and their sort of traceability of the bales? Because I've heard there's been some concerns in the past.
To your first question, I certainly see this extending beyond cotton. We are working and in discussions with other commodity groups. The identity preservation of cotton makes it a little bit easier. I say a little bit easier, but it certainly helps along that respect. And with China and India, they are embracing this technology in some cases even faster than the U.S. So I think the adoption is going to happen. Again, it's being driven in cotton from the brands and retailers that are demanding it. They're saying, look, we have to have visibility. We have to have traceability and transparency of our supply chain, or we're not going to source it from you. And so that's driving this innovation. It's being driven from the brands and retailers, ultimately by the consumers saying, we need to know. Show me, prove it. And so I'd say they are embracing the technology, I would say, equal to, and in some cases, more advanced than what we're doing in the United States. Good question.
Joe.
Joe Barker, in CFC. Just wanted to comment back on the DTN comments and not to exclude the cotton. From a farmer-owned cooperative perspective, this ability for the farmer to access the markets 24 hours a day and have the ability to actually make physical cash contracts, and even though they may not be trading in their own account, they're able to contract physical grain and do those transactions automatically is an amazing innovation in our marketplace in and of itself. And then the FCM community has to track the Tag 50. So all of that data is out there as to how the orders came in and how it's being aggregated. But this is revolutionizing, as it's being adopted, the way that farmers interact with the futures market. So, just a comment, really.
Thank you. Okay, do we have anybody participating by phone that wants to ask a question?
If I could jump back to what
Can
Jim
you
touched on.
for the people in?
Oh, sorry.
Yeah.
Chris Betts, MABA. Jim, you talked about kind of bridging the gap during the government shutdown. I wonder if in a year or 5 years, are you able to start to bridge gaps between normal releases from the USDA, right? So where that data is almost approaches real time, and if that's a positive market impact. So I would open that up to the general committee as well.
Yeah, I think some of the technology that Mark mentioned, what Jay mentioned as well, and having that technology available and then taking that technology and employing it around the data that's out there. A lot of it's already out there to reduce the time to public release. I think the technology exists, and I think the data exists as well. So I think it's just a matter of putting it all together and moving forward on a process to do that. So I think, yeah, I mean, you could see that. I mean, I think the agencies are already making efforts on that basis. So I mean, it's not like they're unaware of this. I think the USDA has done a great job under Secretary Perdue and guidance there. The agencies, I mean, you can already see some of the changes, but it's going to get better, and the time to public release will only shorten. And yeah, I think it's a very big positive net effect for everyone in the industry.
Okay, thank you. Thank you for your comments, panel. We, in the interest of time, are going to forgo the next break and proceed to the next panel. So thank you very much for this panel, and I ask CME to come up. As we begin our next panel, it is on the evolution of electronic trading in agriculture markets by the CME Group. Joining us today are staff from CME to share data and information about the types of matching algorithms used by CME Group in their agriculture markets. Our panelists are Tim Andresen. He's the Managing Director of Agricultural Products and Alternative Investments in the Business Line Management for CME. John Shearer, Senior Director, Global Command Center for CME, and Andrew Vrabel, who's the Executive Director and the Global Head of Investigations. Please proceed with your presentation.
Commissioners, thank you very much for giving us this opportunity. It was interesting in the very first session, there was a discussion around how the markets have evolved and how the markets have become electronified, and that clearly has changed the nature of the markets and clearly has had implications. And I recall as a trader many years ago when we started electronifying the markets, I thought, well, this is easy. You just send an order in and magic happens and somehow I get a fill back. And the reality is it's not that simple. That we are replacing something that had a social dynamic with something that has to have a very rules-based dynamic. And so one component of that are match algorithms. And so what we'd like to do today is talk a little bit about that and in a very educational way. We know it's going to be addressed later today as well. So, hang on, wrong one. So, first of all, what is a match algorithm and why are they important? Well, back when we had open outcry markets, it was simple. You had individuals standing in the pit, hands up, hands down, buying, selling, and a match was when two of those individuals agreed on a quantity and a price. And it was very straightforward. But there were some dynamics about that when you move to an electronic environment are a little bit different. So the first thing was that things could happen in parallel. You could have multiple people bidding and offering to each other at the same time. And occasionally those trades could essentially occur at the same time. A pit, while we obviously tried to make sure that there was as much transparency in the pit, you could still, if somebody's next to you as opposed to somebody is across the pit from you, it's easier to see their bid than their bid, and consequently, things could happen at the same time. Number two, you had a dynamic of, suppose that I'm bidding for 500 of something, and I have 10 sellers with 100 each. Okay, I know I'm going to get filled, but who am I going to get filled from? And quite frankly, I can go, well, 100 here, 100 here, 100 here. Joe's my buddy, 100 here. I did a trade with him the other day, so 100 here. And the other 5 guys, sorry, you're not getting anything this time around. And the other dynamic is that in the pit, you saw the best bid and the best offer. You didn't see the book, and you didn't know what was in the book. A broker had a deck of what he thought was in the book or what he saw in the book. And if you're talking to your broker and saying, well, what do you think is there? You didn't know. So those things, when you move to an electronic marketplace, change. So the first thing is that in an electronic market, transactions occur in a serial process. So think of it as a pipe. When an order goes in, it goes into the pipe, and another one goes behind it, and whether it's an order or a cancel or a modification, it's going through this pipe in a serial process. So we have to deal with the fact that we have to process in this serial process. Number two, when a match occurs, we have to allocate that. So if in the earlier case where there's 100, I'm trying to buy 500 and there's 10 sellers at 100 each, there has to be a rule that decides who is going to get filled in that situation. It can't just be, I think I want to fill this person. It's got to be rule-based. And then the third dimension is that today you can see the whole book. You can see not just the best bid and the best offer, but you can see the depth of the book, so that as you're looking to execute on things, it's not just what's the top of the book. You can more sophisticatedly look at the book and figure out, hey, if the book's showing 100 up and I need to get 300 done, what is the implication of that? So in that context, you have to have rules that are going to decide how something matches. And what we'd like to do is take some time. I'd like to hand it over to John, who can walk you through exactly how some of those rules and how those match algorithms work. And the arrow keys.
So first, thank you for this opportunity. One of our goals at the exchange is always whether it's about match algorithms, risk controls, any functionality on Globex. We want to be as transparent as possible for our customers so that everybody understands kind of what is happening on the screens. So on Globex, the electronic platform, we basically have three algorithms. It's 100% FIFO, 100% pro rata, or a combination of the two. So today what I'd like to do is kind of walk through the algorithm that we have in our grain futures with some specific examples, and so hopefully everyone comes away with a little bit better understanding of how things work. So in grain futures, we run what's called the K algorithm, and all that means is that it's a configurable algorithm. So the grains is a 40% FIFO, 60% pro rata allocation, but there's actually 5 steps in this algorithm. So just to be clear, and when we're talking about who is participating here, so if a market is 7 bid, 8 offer, and there's 100 contracts offered at a price of 8, and I come in to buy 10 of them, I'm the aggressor. So the match algorithm to me doesn't really matter, because if there's 100 contracts there, I'm going to come buy 10, I get my fill. Where this comes into play is all of those customers competing at a price of 8, so they're resting there. How are we going to allocate that 10 lot aggressor? So in the K algorithm for grains, the first step is what we call top order. So what is top order? Top is anybody that betters the market, and I can give you an example of what that means. So if the market is 6 bid, 8 offer, and I put in a 7 bid for 10 contracts, I was the first person at a price of 7. I bettered the market. Therefore, my order will be flagged as top. So, why do we do this? So, in a FIFO market, it doesn't matter. You don't need top because I'm the first one there. My 10 contracts are going to get filled. But in any algorithm where you have a pro rata allocation, I might not get all 10, right? So in the K, if it's only 40% guaranteed FIFO, if we don't have top and I'm the first one there at 7, what happens is generally a lot of customers join me at 7. So now at first I was alone, but there could be 500 contracts with me. Now I only get a four lot, right? Because that's 40% of my 10 lot, and I'm competing with the rest of the people in pro rata. So top is just a way to reward somebody who essentially sticks their neck out. They're the first ones at that price level. So there are a couple rules with top. Number one, there is a maximum allocation you can get. And in grain futures, that's 100 contracts. So all you can get as a top order is 100 contracts. And secondly, there's only one top order at each price level. So once I establish a top order at 7, nobody else is going to get top. So later in our presentation, we're going to walk through actually how these fill reasons allocate on a percentage basis, and you'll see that top is a small percent of the fills. So the second step is FIFO. So it's a 40%, and we call that a target, and I'll explain why. So as Tim mentioned, right, all of this has to be this is all driven by basic math, right? A computer needs to know how to allocate these orders. So in the FIFO pass of 40%, the rule is it has to be there has to be a FIFO allocation as close to 40% as possible, but nothing below that. So what does that mean? 10 lot aggressor comes in, that's easy, right? 4 contracts, 40%, 4 contracts go FIFO, the other 6 move on. But what about a 1 lot, right? You can't split a 1 lot. So the rule there is that 1 lot goes FIFO, even though it's technically 100%. A 2 lot, we're going to take 1 FIFO, that's 50%, but it's above that 40% threshold. The other 1 lot moves on. And in a 3 lot, if you only allocate 1 FIFO, that's only 33%, right? So we got to go, 2 are going to go FIFO. The third one moves on. So as you can see, it is a 40-60 split, but right out of the gate, it's not going to end up being a 40-60% allocation. It can't be. Math dictates that it's impossible. So after the FIFO pass, we go to pro rata. So pro rata, and the next slide we'll get into a specific example for clarity, but pro rata is whatever percentage you are of that price level is the percent of the incoming order that you get. So if there's 100 contracts at that price level of 8, and I happen to be 50 of them, I'm due 50% of that incoming 10 lot. So, Tim kind of touched on this, but why do we employ pro rata in our markets? It really came from how they filled in the pit, and what we tried to do was duplicate that experience, right? So, if a 100 lot comes in, we just don't want it to go to one person, right? We want a smaller trader to be able to compete with the larger traders. So what a pro rata allocation does is it kind of spreads out the dispersion, so that, if I'm a 2-lot trader or a 5-lot trader, that, yeah, I can compete in a market with a 100-lot trader. So in the FIFO, it's got to be a minimum of 40%. In the pro rata, it's 60%. But in pro rata, there has to be rounding in all of this stuff, right? Because you have multiple orders coming in, and you get into decimals. So if in pro rata, we round down. And what that means is, if based on all the orders in the book and an incoming 10-lot, I deserve 1.8 contracts, well, obviously we can't allocate that. So I get 1. If the math works out that I actually get 0.9 contracts, then I get 0. So based on those rounding rules, what always happens is we have residuals. They call them leftovers. So it goes through FIFO, it goes through pro rata, and we employ 2 methods to kind of disperse those residual quantities. So the first one is leveling, and in leveling is simply a second step of pro rata. So again, we rank the orders largest to smallest, but the rule with leveling is you only get a 1-lot allocation. So you're sorted biggest to smallest, but if there's 10 contracts to allocate, the 10 biggest each get 1. And then at the tail end of all of our algorithms, we just have a FIFO allocation just in case, due to rounding, another 1 lot is out there. We send it back to whoever is first in the queue at the time. And what I will say is, starting in 2019, we started publishing to customers on their fills what part of the algorithm they were filled in. So prior to this year, customers didn't know if they were filled FIFO or pro rata or leveling. Now they do. It's just another effort for us to increase transparency and understanding for our customers.
John, can I ask you a quick question?
Yes.
You used, and I appreciated, a very simple example for the top analogy, and maybe I'm thinking about this wrong, but if you had a top of 7, what's the true next increment that someone could go to above that in the sort of matching system?
Well, so in that example, it was 6-8 market.
Yeah.
So I come in at 7 first. So I'm the top bid at 7.
Right. But, I'm thinking, again, I don't know if I'm thinking about this right, but incrementally someone can come in a lot smaller than a single dollar, or, in between 6 and 8. Like what?
Oh, no,
what
I'm
increments?
sorry. In that example, we take in ones.
Just,
so, yeah.
Just taking ones.
Yeah. So
Okay.
it's 6, 7, 8.
Yeah. Okay. Thanks.
So this is 2 examples, and I'll call them kind of extremes on both sides. The top one I would call more of like a textbook example of pro rata. So you have a total of 60 contracts resting on the book, 6 orders each of 10 contracts. Everybody has an equal percentage. A 6-lot aggressor comes into that price, so it's really simple. Everybody gets 1, okay? But many times it isn't that simple, right? So the second example is if you take 1 lot away from that incoming aggressor, make him a 5-lot. Well, now you have 6 orders that are an equal percentage. You cannot split 5 contracts equally across 6 orders, so it bypasses pro rata completely. There is no pro rata allocation. Then it would go to leveling, or it would go to FIFO, depending on the next step on the product. So because of that, and Andrew will touch on this on the next slide, it's a 40-60 algorithm, but the actual allocations are a lot different than 40-60.
So as you can see, if you start to listen to this, it gets pretty complicated fairly quickly. And, the challenge is that you have to have a rule that deals with every one of these situations, with every one of the matches between the number of coming in, the aggressor coming in, and the size and the number of orders in the book. And so, as John said, what we're trying to do with the K algorithm in particular is replicate something that existed in the pit, where it was literally, hey, I'm going to fill you, you, and you, but do it in a rules-based environment.
And while it may sound complicated when John walks through it, At the very
That
end
was
of
not my
this-
intention, sorry.
At the very end of the slides, there's a set of useful links. We have many pages on our website that explains exactly how the match algorithms work. There are videos that go through examples of the different match algorithms. And there's a document called the GlobeX product reference that articulates the match algorithm that is deployed in each instrument, each product, whether outright or futures. So those are all links that have been provided. So the rounding...
Just one quick question on the last slide. So it seems as though it would be fairly common, perhaps, that there couldn't be an equal division. And so in that case, pro rata would be bypassed completely. Does that happen more often than not?
I'm sorry, when pro rata is just completely bypassed because the math doesn't work? Well, so, I mean, the reality of our books is that there are, could be hundreds of orders, all different quantities. So the answer to your question is, yeah, there's almost always some sort of pro rata allocation, but there's also stuff that just can't get allocated. So it's a combination of both. And actually, Andrew's slide here next kind of addresses that specific point.
This particular histogram notes the aggressive order sizes by quantity received in corn futures outrights during the month of January. If you added up all of these bars, you would see that there's around 340,000 aggressive orders that were entered into corn futures outrights. So, Commissioner Stump, yes, there are going to be examples where the rounding, or either the rounding down from pro rata or the rounding up from FIFO, creates ties, where those ties have to be decided by some other component of the algorithm. The importance of this slide is twofold, really. One is to highlight that of the 340,000 orders that came into corn futures that month, roughly 40% of them were one lots. And as John mentioned, the one lot aggressive order is going to get filled either through the top order that's resting or FIFO. There, at the same time, another 200,000 orders that are greater than one lot, where some participant is going to participate in that fill either through the pro rata algorithm or through one of the residuals. So on the right-hand side, you can see what the actual allocations were in corn futures in January. 7% of fills were awarded to the top order. 56% were awarded FIFO. So if you combine those two together, you're at roughly 63% of fills went based on time priority. And then the remaining 23% went pro rata and 14% went leveling. What's value about this is that the pro rata and leveling component does allow participants who aren't the first in the book or don't want to stick their neck out to be a price changer to still participate in orders. I'll switch gears. I can easily come back to this in a bit. And I want to cover trade practice observations. At a conference not far from here last year, there was some, I think were misinformed comments about spoofing and the propensity to see spoofing activity in markets where there are pro rata components to the match algorithm. So I wanted to share my observations from actually conducting spoofing investigations. The visual that you see up here are the spoofing citations that we've logged and reviewed over the course of the last 15 months. And I categorize them by citations based on whether the product at issue was a pure FIFO instrument or was in one of the other match algorithms. And you can see that just over 71% of our spoofing citations were in FIFO products, with the remaining 29% in a market that has some sort of split pro rata or pure pro rata component to the algo. The reason why we see this type of distribution, at least from my perspective, is due to a couple factors. But let me first lay some groundwork on what spoofing is. A vanilla spoofing instance involves a trader or participant who enters one or more orders on one side of an order book, who intends to cancel those prior to execution. He typically also has a smaller order on the opposite side of the book that is advantaged by the large spoof orders. After that intended small order trades, the spoofer cancels the large spoof orders that he never intended to trade. The reason why spoofing, that vanilla form of spoofing, is successful to traders and violates our rules and federal law is that order book imbalances tend to predict future price movements. When the total depth or liquidity on the buy side of the market is substantially greater than the sell side, the market tends to rise. And when the sell side is greater than the buy side, the market tends to fall. This is our observation. It's been written about in academic articles. It's been the testimony of victims in spoofing cases. So that is the principle that the spoofer is looking to take advantage of. They create an artificial order imbalance with the spoof orders, which causes others to move the market up where the spoofer has a smaller order. So the reason why that's important is that in pro rata markets, we tend to see greater depth and liquidity in the market, which means that in order to create an imbalance in that marketplace, the spoofer has to put in larger sized orders in order to cause the market to get out of balance. So that's important from two aspects. First, it takes a lot of risk, not only in risk limits, but in just exposure risk by having large size spoof orders in a market. And that risk is actually compounded in a pro rata market because the pro rata component of the algorithm could cause fills on those spoof orders that the spoofer never wants to actually get filled. So if you compare that to a pure FIFO market, a spoofer can manage where his order is in the queue at a particular price level. So if he doesn't want to get filled on his spoof orders, he can continually modify those orders to stay at the back of the queue so that other traders, if there is going to be a trade on that spoof side, will get traded against rather than his order. So we tend to see greater risk to spoof in pro rata markets, not only because that spoof order has risk of getting traded against, but also because you have to put in much larger size in order to affect a spoof there. The one component that was addressed at this conference last year that was somewhat misinformed, and it relates to the depth that we sometimes see in pro rata markets. In many pro rata markets, the liquidity and depth, as I mentioned before, is deeper and greater than in a FIFO market. And there are a couple of reasons for this. There are probably many reasons for this. In most pro rata markets, those are instruments that have less intraday volatility. The prices are more stable. So participants can put in larger size orders with less risk. The other component is that traders will put in larger orders in pro rata markets so that they can take advantage of the pro rata component of the algorithm. Obviously, the larger order they put in, the larger share of the pro rata match they'll get from that order. The distinction that has to be drawn by participants that enter large size orders in pro rata markets and spoofing is that the trader in the pro rata market actually intends for his order to trade. When he enters it, his intent is for that order to trade. Versus a spoofer, when he puts in that order, he never actually intends that his order is going to get executed. And he may often take actions to avoid that order from being executed. This distinction between entering an order in a pro rata market that may be larger than the trader ultimately wants to be traded and spoofing was actually called out in the CFTC's Advanced Notice Proposed Rulemaking when it was soliciting comments on the spoofing provision because the CFTC asked a question that said, how should the Commission distinguish between spoofing and otherwise legitimate conduct of entering large orders that subsequently get canceled after a partial fill event. So at the same time, we don't, from a market regulation perspective, completely discount large orders in pro-rata markets. We spend an inordinate amount of time analyzing them. And our rule on disruptive trading practices provides that any participant that enters an order in any market must have the financial capacity to take full fill of that order. So obviously, if you have a corn spread market that's 300,000 contracts at the best bid and best offer, and you try to spoof that with 150,000 spreads, we're going to come to you and we're going to ask, what are your lines of credit? How much excess capital do you have? How do you determine the risk profile of receiving full fill on that? And those are inquiries that we actually send to participants in these markets, not only to ensure that their intent is true when they enter those orders in the markets, but that the integrity of what the marketplace sees is actually true and correct. So again, happy to address any of these points. The links I'd mentioned before on this last page. Maybe happy to field any questions.
Thank you, Andrew. Do we have any questions here? Robbie?
Robbie Boone, Farm Credit Council. Appreciate the presentation. And I guess, Andrew, you mentioned the depth of liquidity. That issue generally. I guess one of the things we worry about is the liquidity, particularly in a market event in particular, where we're hearing that, from market participants, they're typically tight bid-ask spreads, but then we hear from customers that those trades kind of will fade out, which I know is not, the fading out, as I understand, is not spoofing. But, certainly high-frequency traders are thought to be actors in there and sort of query how much in a major market event would the high-frequency traders actually be, active market participants. I think the term is illusionary liquidity, illiquidity is something we're concerned about. So, and also our understanding is, things like the Volcker rule have limited the activities of some of the, prop trading, which, could help provide more liquidity in these markets. Just any thoughts about sort of the impact that's going on?
In terms of the general liquidity provision, one of the things that Tim mentioned is the pipeline coming into Globex. Every order is handled in sequence. It's not uncommon during rolls to see participants send in multiple max size orders that are sequential once they arrive at the gateway, or handled sequentially at the match engine, that end up taking out sizable portions of the bidder ask. In some markets, it's not uncommon to see 75 or 100,000 contracts trade within milliseconds. So that liquidity provision is real. It's actually there for people to take. With respect to when you get around market events, we study market events almost on a continuous basis to try to understand who's going to be there when the market moves and who isn't going to be there. And I think what your observation is right. Markets today respond more quickly than they ever have before, and it's because it's not just the HFTs, but anyone operating an algorithm has an ability to adjust their prices much more quickly than before. And when we've studied these events, we've actually seen, and I think it's consistent with academic literature, that the market prices tend to come to the expected value much more quickly today than they did in the past. Obviously, when you have significant market moves, some participants will choose to completely pull out of the market. Many will actually stay in to provide that liquidity for participants.
Thank you, Mr. Strong.
Yeah. So for John, in the top order of the book, the 100 lot that gets priority. Does the 100 lot get any other priority in the pro rata section of the book?
Well, because he's got the first priority of, so let's say I get top for a full 100 contracts. the first 100 contracts that come in, and if I'm trying to buy it, the first 100 sellers that come in are going to come to me. So it never makes it. I'm already filled by the time it makes it to the pro rata pass. So I'm not even participating anymore, because what top does is it puts you out in front of everybody. If you are that top order and I want to buy 100 and I earned it by being the first one there at that price, first 100 contracts come to me, then subsequently any other customers are behind that, and that's where it will go into your FIFO 40%, then it'll move to pro rata.
Okay, so if I put in a series of 100 lot, if I put in a series of 100 lot orders, only one is going to be top.
Correct.
And then when it goes to pro rata after I get filled on the first 100, the balance, say 300, only gets the pro rata amount of what I am of the total book.
Correct.
Right? That 100 lot doesn't gain me any additional advantage in the pro rata section of the algorithm.
Exactly. Orders are treated, so it's not by customer, it's by order. So my first order of 100 was top. If I have 3 other 100 lot orders, those are completely independent. There's no relationship at all. And it's important to note, like with the characteristics of top, say somebody comes in and I'm a 7 bid for 20 contracts, I get top, and then I decide I don't want it, I cancel it. Nobody else is getting top at 7. It's just that first order, and it doesn't matter if it trades or if it's canceled. Nobody else can get that top. So it's kind of exclusive, and that's why that only 7% of the fills are allocated to top order.
Okay. Sorry, Tim.
And Steve, one more thing. So you described putting in 4 100 lots orders. So once the first 100 goes in and it turns the market and it gets top, the whole algorithm runs. So your other 3 orders aren't even considered until you run through the match engine once. It processes, it locks the book, it processes what's in the book. Then you go to the next stage where your next 100 would go, assuming they're exactly back to back. Then the next 100 would be in the book. The match engine would run again. So those are in the pipe, but not at the point where they're being processed by the match engine.
Okay. All right, got it. And for Andrew, there's been tons of discussion about the canceling of these large orders, whether they sit on the bid or the offer, and it offers a lot of frustration to traders when they try to lift the offer or the bid and they can't get all of it. Can you offer maybe? I mean, you said you spend a lot of time looking at orders that are just canceled because market conditions change, and others that are canceled because you're suspecting there's spoofing involved. Can you offer any other color commentary on that? Sorry.
There are a number of key factors, and I hear this question often. We receive a lot of phone calls in market regulation where people say, I tried to get this fill, and the order wasn't there when I got there. And the first component of that is understanding exactly how much time it took between they thought they were entering their order and when their order arrived at the gateway. Because that time is really critical. I was looking recently at the average latency from one of the I call it top line front end systems from Nebraska, Kansas to Chicago. It was around 10 milliseconds, and that was for kind of the top of the line. So you have to assume that the market may change within that 10 milliseconds. It could be much longer depending on how you're actually connecting. So that's the first, to make sure that the quantity that they thought was there was actually there when their order arrived at the match engine. And I field a lot of questions like that where I actually provide customers their nanosecond level timestamps to show when we got the order relative to when they sent that. The second component of that is when there's a large trade event, it's not uncommon to see liquidity decline fairly quickly shortly after that. And it's because a lot of participants that are in these markets that are running algorithms, they may say, if I get hit on 5,000 offers, look to every other market and see where I can get out at a tick. If I can't get out at a tick, look to every other market, see where I can scratch. If I can't scratch, look to every other market, see where I can get out at a 1-tick loss. So if they have 5,000 there, they're instantly looking to get out of that position, so they may start aggressing in some other market. So that size that they had there, they'll cancel remaining size and they'll now become an aggressor on the other side of the market. And that's what we tend to see when there are drastic changes in the debt profile over very short periods of time.
Right, thanks.
Thank you, Tom.
Tom Cadillac, representing FIA and the FCM community. A comment and a question following on Steve's. That's the number one question we've gotten over the years. I think you're well aware of it, obviously. So forums like this and getting out and talking about your rules-based matching system, I can only encourage you to do that more. We will try to discern what you've done on the website and get it out to our team, and probably ask you to participate in some of the dialogue, which is very positive, I think, for the community. Andrew, you touched on my question, which is we support a dozen or so order entry platforms. How much does location and speed affect the matching algorithm? So location of the platform and the latency of the platform.
I don't think the location of the platform and/or participant has any impact on the actual match algorithm. It has an impact on, from an aggressive order enter's perspective, whether they can execute that order. If you're a passive participant, you're resting in the order book. That order is resting, on our match engine. So even if you're in Kansas and you have an order resting in the book, it's going to get filled when there's an aggressor order. The biggest question is how long it takes that aggressor order to get from the Midwest to Chicago. And all that depends on the connectivity that they have through their firm.
So is it fair to say that speed is the absolute most important aspect of any order entry platform that a firm could have?
It depends on what you're trying to compete for. And I've mentioned this before to a lot of people. There are a lot of people that have a competitive advantage based on the information that they possess from being in the field. They aren't the ones that should be competing for stale quotes. Because they're competing against a guy who's invested millions of dollars in infrastructure to be in Chicago to have the lowest latency possible. So again, it depends. I mean, your strategy dictates how speed sensitive you are.
Okay, thank you. Ed Gallagher?
Ed Gallagher, representing the National Milk Producers Federation. Tim, you mentioned that when when you were thinking about how you would set this up, you wanted to try to match open outcry, and that in that you can't do that, right? Because you used your example, and any one individual would pick different people randomly, maybe. So, is there one algorithm for all your markets, or are there multiple algorithms for different markets, or multiple algorithms within a typical, in a particular commodity?
Well, so there can only be one algorithm active in a given commodity, though there can be one in futures, one active in options, which is separate. We do have multiple algorithms. Quite some time ago, we looked and selected what we thought were the most effective algorithms for a given market. In the case of the K, there's parameters like what is the FIFO commodity or the FIFO layer, how much is it? So those are things we look at. I can't say that we have changed any of those things recently, but those are conversations we have as to how effective is this working? Are we getting the results we want from this particular algorithm?
Could you have multiple algorithms, pick your commodity, corn, that you sort of had 5 and that you randomly used a different algorithm every day to sort of change it up a little bit for the computerized traders that couldn't predict that algorithm easily?
I may let these guys jump in on this, but I think that the short answer is that you could do that. You could say, hey, today we're going to employ this algorithm and tomorrow we're going to employ that algorithm. It wouldn't take a super sophisticated trader very long to figure out which one it is and adapt to it. So if you had 5, people would figure out what those 5 are, and literally, within seconds, they would have adapted their algorithm to say, this is how my trading algorithm to optimize versus this match algorithm. John, do you want to?
Yeah, I would just add that, while we have several different types of algorithms, one being the K, at the end of the day, it's really only FIFO, pro rata, or combination. So what I say is we actually only have 3 algorithms, and one of our goals with algorithms and everything else the technology that we have is we actually want to be as simple as possible. Being more complex doesn't necessarily make things better, and it can disadvantage other people. So, in a perfect world, a FIFO algorithm is simple for everybody to understand, and so why don't we deploy FIFO across the board? Well, because customers say that they can't participate in those markets. And I'll give you an example like our Fed fund futures. They might trade one price level an entire day. Fed funds might trade one price level an entire week, right? So if I'm a big bank and I have 50,000 contracts and I'm first in line, well, you know what? Everybody is behind me and they cannot participate in any activity until I get filled, right? So we run a pure pro rata in Fed funds for that reason, because we want to spread participation out, and you don't have to be a big trader to participate, right? So that's why, depending on the product, we'll either go 100% FIFO, 100% pro rata, or we'll kind of mix them together like we do in grains.
Okay, thank you. Okay, one more question.
Yes, I got to apologize. I have to leave early, so I have to head out. I want to thank the commission for meeting today and for the entire group to be here. This was a very productive meeting. I thoroughly enjoyed it. I learned a lot. Thank you to all the panelists, and I'm looking forward to the next time we get together. Thank you.
Thank you. So I think we have one question from the phone panel, the panelists on the phone. Can you all mute your phones except for Neil Driscoll from the Managed Funds Association? And you may ask your question.
Am I unmuted?
Yes.
Is it working?
It is.
Perfect. There we go. Okay. Sorry for the delay. So I have 3 questions specifically about the matching algorithm here. The first one is, I think, hopefully a pretty easy one. Why cap the top of book at 100 lots when that's less than 5% of a max order size? And it's going to lead to my next 2 questions, which are, what is the time to actually go through the K algorithm, the 5 steps? Is it a millisecond? Is it many milliseconds? And then the third question is, during those 5 steps, are all orders locked, or can any of them be amended at any given time during the 5-step allocation?
So your first question around why is top max 100 in corn, and it's much higher in other products. So that pretty much comes from customer feedback. In a lot of products, we have the top max equal to the max order quantity. So to kind of align that up, in corn spreads, the max order quantity is 10,000 contracts. That means that you can enter 10,000 contracts. That's the most you can enter in one order. So our top max is only 1,000 contracts. So again,
why be 10% though?
Again, that Tim actually, his team reached out. We had a lot of customer feedback. People are fearful that they don't want to get locked out. That 10,000 is a lot, and if it's not a pure FIFO algorithm, there is a pro rata component, and there's reasons for that. So they're afraid that having a top max of 10,000 is going to lock other participants out.
I'm sorry, you guys are undergoing a trial for that max 10,000, correct? I mean, has the feedback been positive or negative?
We underwent a trial late last year, early into this year, and we've in that particular case, it's now standard. We've gone from trialing it.
So the feedback was very positive.
Feedback was very positive, yes.
Are there steps and decisions to change the max 100 lot for flat price? That seems extremely small in a market that's trading this type of volume.
Those are always, what you're asking is about what we define as kind of gray areas. We're not sure there's a optimal answer for that, and that's where, in the case of this, we talk to customers. There are certain people that would definitely share your view. There are certain people that would view that you want to keep it as a small amount. So those are the conversations we're happy to have across the industry with what we think the right answer is. Do you want to touch the second two parts of that too?
Sure. So I believe the second question is how long does it take to go through an entire iteration of the K algorithm? And the answer to that would be and I think it answers your third part, it's the same time. So we are continuous trading. The match engine is continuous trading. But when an aggressing order comes in, even though it's a computer and it's very fast, it needs to kind of stop. It takes visualize it kind of taking a picture of what exists in the book right now. And then the match engine needs to figure out, okay, based on this 100-lot aggressor, and let's say I've got 1,000 orders, how am I going to allocate it? And it starts with top, then it goes to FIFO, then it goes to pro rata. During this entire time, it's not listening to incoming orders. Nobody's modifying anything. It is the number one rule of our match engine is to fill that aggressor, if it can. So, and this goes back to some of this disappearing size and, I tried to buy something and it was no longer there. If there is 100 contracts on the offer and I go to buy 100, I'm going to get filled on all 100 every single time. Nobody's getting out of the way. Nobody's canceling. So once that aggressor comes in, that triggers what we call a match event. When a match event is triggered, anybody that's in the book, they cannot do anything until that 100-lot or that aggressing size is filled. So whether it's a FIFO algorithm, whether it's a pro rata algorithm or a combination, the timestamp is going to be the same millisecond.
Sorry, can we use an example actually that would go above the top of the book? Because I think that might be where I'm a little bit confused. Let's say the order book is 100,000 on 200,000, and the 200,000 offer, I'm an aggressor for 10,000 lots. So the 100-lot guy that's sitting there on the offer side, that gets filled first before it goes through the rest of the book. So my question is, anybody else on the offer side, once the 100-lot is fixed and matched, can they amend their orders? Can they cancel their orders?
No. If a 10,000 lot aggresses into a 200,000 lot offer, the first 10,000 contracts based on the algorithm are all filled at the same time. So yes, the matching engine will say, okay, it's got to go through steps, right? So, okay, I've got 100 top, so he gets the first 100. But it is filling that entire 10,000. Nobody can amend anything. Nobody can cancel anything. They are getting their fill.
Okay, and then, sorry, just one more example, because I guess I've been a participant that has experienced this too many times. Instead of 200,000, the offer is 15,000. The bid comes in for 10, and you don't get filled. You're telling me that there's a time delay in there and people are just massively changing their orders fast enough that the matching algorithm can't keep up?
No. So you I couldn't quite hear. You said there was 15,000 on the offer and you came in to buy 10,000 and didn't get any?
Only got a partial.
Okay, partial. So again, and like Andrew, we deal with these kinds of questions from customers all the time. If there is 15,000 contracts on the match engine, when your 10,000 lot arrives, you will be filled 100% of the time. There's never been a situation where you weren't filled. Now, the difference is you see 15,000 on your screen does not mean that 15,000 is still in the match engine in Chicago, right? It could have already been traded out. And to talk about extreme examples, so we work with customers. They give us the exact time, everything. We walk through it. And one of the first things I ask customers is like, what kind of computer are you running your front end on? What other applications are you running it on? And honestly, I've had a customer tell me, well, I've got my charting software and I'm actually streaming a Netflix video because the markets are slow. And then I see this offer and I go to buy it. Well, like anything else, there's only so much capacity that your computer can process. So it's going to be slower, right? So, look, we live in a millisecond world here, obviously, in trading. So when we troubleshoot these exact complaints, the answer is always the same. When your order arrived at the match engine, that quantity had already either been canceled or had already been traded out.
And if I can jump in for a second, both these guys have talked about doing that. If a customer has a question, if they say, hey, I was trying to get this done, I didn't get this done, call us. That is exactly what GCC is for. If a person has a concern about spoofing or something, let us know. We are very, very receptive to digging into these things, into pulling data, into saying, here's exactly what here's when your order came in, here's exactly what the book looked like when your order came in, here's exactly why something that you thought should have happened didn't happen or did happen. We are 100% happy to do that, and that's what the whole...
Yeah, we do it all the time. It's in market data every single trade, and when we're working with individual customers, we can share your absolute timestamp of when you arrived at, in Chicago at the matching engine, and we walk you through that whole process.
Okay, thank you. I'll turn to the commissioners and chairman for any remarks before we move to the next agenda item.
Just one quick question. I realize we're on time. So this particular algorithm is what you've chosen for the agricultural markets, but there may be, based on participant feedback or what, in different commodity markets, you would have a different algorithm?
Yeah, like in livestock, it's FIFO. And in livestock spreads, it's the K algorithm. So a lot of it depends on the characteristics of the market, how much it moves, along with certainly customer feedback. Like everything we do, we try to get as much feedback from customers as possible because they're the ones that are transacting on our, at the exchange.
Okay, thank you, panel, for this discussion, and we will move to our next panel. On the next agenda item is other new business. I would like to begin with a staff recommendation for consideration by the AAC. I will now turn the floor over to Krista Lackemeyer, Senior Economist in the Division of Market Oversight, to walk you through the proposal.
So thank you, everyone, to the chairman and commissioners and all the members for their active engagement in this meeting. In terms of subcommittee recommendations, we had one based on some experience this year and past year in the agricultural markets, and we thought it would be useful for the committee to perhaps form a subcommittee and provide some recommendations. And in order to set that up, I'm going to do a little level setting. So the commission regulates based on statute, which is provided to us by Congress and signed by the president. And then we have our own rulemaking authority to make regulations. We also have the ability to create non-binding guidance. And so prior to 1974, when the commission was formed, we regulated a list of agricultural commodities. And after 1974, that we were no longer regulating a list, we were regulating commodities in general. And then in 2000, we went to a self-regulatory model with self-certification. So exchanges no longer had to come to us each time they wanted to launch a new product or make a change to one of those products for specific commission approval, with the exception of the list of the original agricultural commodities. And the reason that happens is because we don't want to be changing goalposts, be changing the economic characteristics of a product while it's being traded without the commission weighing in. So that seems like it's worked well for all of us, but there is a second conversation that we've been having that's come up a few times this last year about the implementation schedule. So typically these changes have been made between crop years, and that hasn't been so much an issue because the pricing characteristics between crop years is something that is uncertain. So if you change the contract terms within that period, no one has a preview into a crop that hasn't been planted or one that hasn't been harvested. So this past year, there were several changes to the Kansas City wheat contract in terms of the storage rate, and then also corn, soybeans, meal, and oil. And there were a lot of conversations about the correct implementation schedule so as to minimize the impact on the economic characteristics and people who are already trading in the markets. So it causes the exchanges a lot of consternation. They bear a lot of risk in terms of their customers, and the commission has to weigh in, but we don't have any guidance. We don't have anything transparent about, how it is the exchanges are supposed to make these changes and when. So, we think it would be appropriate to go to you and solicit recommendations on, is it the crop year? Is it the percentage of full carry? Are there specific terms that should only be changed at specific times? Is there a way that we can be a little bit more thoughtful as a regulator in terms of providing the exchange with this guidance? And it's my understanding that they would really welcome this. So that's our recommendation for a subcommittee.
So the motion before us is to adopt a new subcommittee dealing with these concerns. Is there a second? I see a second. All in favor, say aye. Any opposed? The motion has passed. Thank you, Krista. Thank you. Before we go to the commissioners and the chairman for the closing statements, I would like to entertain any comments from the AAC members here with us today. I know Mr. Robbie Boone has a comment.
Thank you, Charlie. And I will, just because of time constraints, will ask that the statement gets submitted as part of the record. I would like to just say that Congress gave the Farm Credit System a unique mission to serve rural communities and agriculture over 100 years ago. And we certainly, although we have a prudential regulator, the Farm Credit Administration, certainly appreciate the longstanding relationship we have with the CFTC and the things, again, the content of this meeting was terrific. As of the end of this calendar year, we had approximately $272 billion in loans, particularly to the second panel, and didn't have an opportunity to mention this. Less well known is about 10% of our loan volume is to support rural infrastructure, and broadband is really important, and particularly the comments that Mark Pryor made. You've got to have broadband, particularly for a lot of producers, not just producers, but for our rural communities to continue to thrive. Farm Credit's honored to coordinate a rural infrastructure coalition called Rebuild Rural. Broadband is one of the key planks. So, again, thank the Commission for holding this meeting today.
Just to respond to Robbie, if there's anything we at the CFTC could do to help in that regard. I know a number of our oversight committee members are very involved in this effort to bring broadband to rural communities. If there's anything in particular you think the CFTC can be doing in areas that are appropriate for our jurisdiction, please don't hesitate to let us know.
Thank you, Mr. Chairman.
Okay, thank you. Is there any other? Thank you. Mr. Strong.
Yeah, Steve Strong with NAGA. Krista, thank you for bringing that subcommittee suggestion. And we and NGFA certainly support trying to make the message of more consistent between the Commission and the exchange, so it gets a lot of clarity of where people are supposed to be on certain issues. I guess I'd just like to comment that the CME also has an issue coming up in 2020 with the closure of many of the locks on the Illinois waterway, and we are totally supportive of the we know that those contracts have a certain amount of open interest in them, which could be substantial, but the rule change that's necessary, if it's not made, could be very disruptive to spreads from like May forward of 2020. So I just thought I'd call that to the Commission's attention. And my third comment is that one thing that is really that we hear at NAGA and NGFA is that a daily commitment, a trader's report, boy, would sure be desirable. As fast as managed money has become and as big as they are in our markets, the exchanges produce volume and open interest and all these large trader reports on a daily basis. And I know that there are some limitations currently that the Commission deals with to produce the weekly report. We did support some budget increase for our regulator this year, which is a little bit unusual for our industry, but we'd be happy to revisit that if necessary in the future to get funds associated to increased frequency of the COT report.
Okay, thank you.
I just want to say a word about the COT report. The COT report is a longstanding report by the agency. It goes back decades. Its frequency has increased from, I think, a few times a year to now weekly. The fact of the matter is our agency has been underfunded for a long time. To take the COT report to the next level, which we have considered and discussed and would all, I think, all five of us would like to do, to improve its sophistication and utility, it will be a major investment. And under our current funding, we just simply can't do it. So the clear fact of the matter is it's something we would very much like to do, but it will require a different level of funding than we have before us now. But that would be something that we would like to be able to provide greater data and better data and more timely data to the marketplace. But it's a higher level conversation because it will require a significant amount of investment.
Okay, so maybe this goes offline, but if there's ways that you think that NGFA or NEGA can assist in those higher levels of discussion to get you the resources you need, we welcome that discussion.
Thank you. Thank you for the comments. Is there anyone on phone participation that would like to speak? Okay, I would like to turn to any other commissioners for any closing remarks.
I'll start. I just wanted to say I found this tremendously helpful. There just aren't enough hours in the day for us to get to see all of you as frequently as we need to. So it's really great when everyone's together and talking about these issues that are very front of mind. But as I said, we're in Washington some of the time. We're in Japan some of the time. We're in Europe part of the time. So it's great to have you all here together, and I really enjoyed conversation, and again, this is my first Ag Advisory Committee meeting on this side of the table, so it was very interesting to sit and listen as opposed to help contribute. So thank you all for being here.
Thank you, Commissioner Stubb. Commissioner
Berkowitz. I would like to thank all the panelists today and also those who put the agenda together, Charlie and others who worked on it. I think the agenda was, for me, extremely beneficial and educational, and a number of these issues I'm aware of, and we're dealing with them in other contexts. As I mentioned, the future of FCMs, this will be touched on in next Wednesday's Energy and Environmental Markets Advisory Committee. Certainly cash market innovations and use of data is something at the forefront. Algorithmic trading, we've had presentations on that recently, but the value coming out here and listening and hearing about the specific impacts and how does this affect like somebody growing rice in Louisiana or corn and beans in North Dakota and livestock markets and availability of credit for the agricultural industry, really the concrete impacts, and it helps us understand these aren't just abstract issues that we get in comment letters and we put in Federal Register's notices to go whichever way. They're real issues that affect real people. And a number of the sectors of the economy which are critical to our national well-being. So I really appreciate the effort and the presentations today. Thank you.
Thanks again to Mr. Chairman. I would say I can't add much else than what Commissioner Berkowitz and Stump said. They said it very well and eloquently, but engagement, transparency, we're all about that, and I think we learned a lot from all the panelists that we hear a lot of issues back in D.C. They're often one-sided in the sense that we're hearing them from a very specific constituency. But these meetings give us all the opportunity to be together and ask questions and answer questions at the same time. And I think we learn things, we have a better understanding of things, and I think we can leave and go home and think about things differently. So good to see all of you. Again, thanks to Charlie and Krista, and look forward to the balance of the few days here.
No, just a quick thank you to the panelists and to all of you for making the trip and being with us in person and sharing the benefit of your experience. Any concerns that are based on that experience are incredibly valuable to us, so that we know what questions to answer that can provide you a better sense of market integrity and make sure that the markets are working for you. So thank you, and thank you to the staff for another great presentation, another great advisory committee meeting.
Thanks to the presenters. Thanks to Charlie, who did a great job as chair, to Krista, to Ann, and to our audiovisual team. Thank you very much. I really want to just address my comments to the members of the committee. You're all on this committee because you represent a different facet of the food chain, literally in many cases, but the agricultural industry. And you represent your own firms, but you really represent agriculture in these deliberations. And so I thank you for giving up your time, being here both in present and those on the phone. But I also encourage you to really see this as an opportunity for the industry to come together and question, raise issues, bring issues to the table. This is one of the few but very important vehicles we have to learn, to understand, to explore, to raise issues that are of concern, things that may not be working that could work better, and then how do we collectively find ways forward. So I thank you for your input today. We will have further meetings, and I ask you at each one of them to come, as you have today, prepared, thoughtful, bring issues to bear, because we're all in this together to make our markets better as best as they can be. And this, you're representing more than your own firms. You're representing the entire industry here. So I thank you. It's a big responsibility, and we're grateful for your work. Thank you.
Thank you, Mr. Chairman. It's been a pleasure of chairing this meeting today, but I really have to thank Krista Lachenmeyer for all the behind-the-scenes hard work that she has done to put this meeting on. I am merely the face. She is the true one to get all this accomplished. And I'd like to thank the AV team again and everyone else, and Ann Wright and Anna Rosenberg in my office for helping put this together. And Donna, thank you wherever you are. I know you are out there tweeting about this. So I really appreciate you. And I want to thank everyone for attending. I want to thank the members of the committee, those on the phone, and the commissioners and the chairman. And I hope that all of you can join us at the 2019 Ag Futures Conference in partnership with Kansas State here starting in about 25 minutes. So see you there. Bye.